In this presentation, we will discuss depreciation methods, including the straight line method, the double declining method, and the units of production method, as well as other discussion topics related to property, plant, and equipment, or fixed asset accounting. This will be a long presentation. If you would like to jump to relevant points within it, take a look at the description below, which will have links to those relevant points, as well as a description of what will be included at those relevant points. If you would rather see this information in a playlist type format, we will also have links to a playlist type format, as well as links to other related accounting topics. In this presentation, we will discuss property, plant, and equipment. Note that property, plant, and equipment may be called plant assets or depreciable assets, and property, plant, and equipment will include things that are tangible. Tangible meaning we can actually touch them. They're things that are physical, tangible, we can move them around typically. They're going to be used in the operations. So when we think about the tangible property, the same type of property could be either inventory or property, plant, and equipment, depending on the use of that property. In other words, if we had something like a forklift and we used it for the business, that would be a form of property, plant, and equipment. However, if we're in the business of buying and selling forklifts, then it would be inventory. So we're talking about those types of tangible assets that are going to be used in the business for business operations, and they have a future benefit. So note that all assets basically have a future benefit. That's why we hold them. That's why they're assets. That's why they're not expenses. We have not yet consumed them in order to help generate revenue in this time period. We're holding them with the hope that they will help us generate revenue in the future. When considering property, plant, and equipment, we often have that question as to should we put something on the books when we purchase it as an asset, or should we put it on the books as an expense? Most of us intuitively know that certain things should be assets, such as buildings, such as equipment, and we'll take a look at those examples. However, we don't often know exactly why we intuitively know this. And the rule is because of this future benefit. If we're purchasing something and it has future benefit, then oftentimes it should be put on the books as an asset. If we buy a car, we're not consuming the car today for today's use. We might be using it a bit today, but it's going to be used a long time in the future and therefore should be capitalized on the books and then expensed over a time period. So these are going to be the components of the assets that we're talking about in terms of property, plant, and equipment. The life cycle of property, plant, and equipment typically will start with the acquisition, with the purchase. So for example, if we're purchasing a building, we're going to have the acquisition first. Then we're going to allocate cost to the periods benefited. And that's going to be the key point here. That's why we capitalize it, because we cannot allocate the cost at the point in time that it is purchased, even if we pay cash for it, because we're going to be consuming this property, plant, and equipment through future time periods, and therefore under the matching principle must allocate the cost to those future time periods when it's consumed in order to help generate revenue. So of course our problem is going to be how to do that. We're going to have different ways that we'll talk about how to best make that allocation, and we'll need estimates in order to do that. At the end of the assets or the property, plant, and equipment's life, we will typically dispose of it at some time. Most property, plants, and equipment will not last forever and will have some point in time where we will need to dispose of it. And that's going to be the major three kind of journal entries that we'll need to be making when we buy property, plant, and equipment, which is pretty straightforward. We're just basically going to debit property, plant, and equipment an asset and credit whatever we pay for it, cash or a loan. The tricky part will of course be the allocation, and we'll talk about different allocation methods and how to calculate allocation methods. And then we'll have the disposal, which can be a little bit tricky as well because we will be introducing a new account, and that's going to be a contra asset account, accumulated depreciation. We've probably seen it before, but we haven't really calculated it and worked with how that number comes about. The acquisition cost is going to be part of the property, plant, and equipment, and that's pretty clear. When we purchase property, plant, and equipment, we know that the purchase price of it will be part of the cost. But it's also important to note that expenditures to prepare for use will also be needed. So if we're putting something in place, if we have to If we bought a refrigerator and we had to put the refrigerator in place and pay for that installation, then that installation, although it wasn't the sticker price, is part of what we need to get it up and running and in operations, and therefore would be part of that property, plant, and equipment that we would capitalize, not expense, and then allocate over the useful life. So if we talk, there's a few different categories now of property, plant, and equipment. One is going to be machinery. So we're talking machinery and equipment. And that, of course, when we buy something like a forklift, it's going to acquire, we're going to have the acquisition cost. We're going to have those expenditures expenditures to prepare for use of that forklift. So whatever we need to do to get the forklift up and running, in addition to the acquisition costs, we're going to include. Obviously, the price is going to be included in terms of what is capitalized. What we're adding up here is what is going to be capitalized as this forklift. And you would think it would just be the sticker price, but all these things would be included. The acquisition cost, the expenditures, the price would be related to it. The taxes, if we had to have sales tax on the forklift, that would be included. Any installation, obviously a forklift, if we had to transport it here, probably installation wouldn't be here, but transport would possibly be here. If we had to buy the forklift and then ship it, then we wouldn't be able to just expense the shipping costs. And note, that's really the difference here that we want to keep in mind. The question would be, well, what about the sales tax? Can we expense that, or should we capitalize it? No, we need to capitalize it because we're purchasing the forklift. What about the installation? If we had to install anything to get the forklift up and running, can we expense that, or should we capitalize it? Well, if it's for the initial purchase and we need to make the installation, we should typically capitalize it as part of keeping the forklift up and running, getting it ready for use. Transportation, should we expense that if we had to pay for the transportation in addition to the sticker price of the forklift, or capitalize it along with the forklift? We should capitalize it typically because we needed the transportation in order to get the forklift up and running and for use in the operations. Transport insurance is another example. If we had to pay for insurance during the transport process, that should be capitalized rather than expensed as well. Another category of property, plant, and equipment is building. So if we purchase a building, we have similar type of things. The question is, well, what are we going to include in the cost of the building? Similar reasoning would be in place, but we have a few different factors when considering the building. Obviously, the purchase cost or construction would be in the building. So if we just bought the building, then whatever the price would clearly be in it. If we construct the building, then it can be a little bit confusing to think about, because the construction process could be a long process, and we're basically capitalizing everything through that entire process of constructing the building as part of the cost of the building, meaning we're not typically expensing anything during that construction process. We're going to put it on the books as a capital asset. The title costs, taxes, broker fees for the purchase of the building, attorney fees for the purchase of the building. These are all going to be things that will be capitalized along with the building because they're needed to be done in order to get the building up and running. And again, the question would be, well, can we expense these things, or should we capitalize them? And it really depends on your angle as to what you would want to do as a business. Like, what does the business owner, would they like to do? Notice that capitalizing typically makes the business look better because we're putting the asset on the books and we're not expensing it over time as quickly. We're not just writing it off at this time period, and therefore net income will typically be higher as well as assets. However, for taxes, we would typically want net income to be lower in order to write off more deductions and have lower net income and lower taxes. So depending on what your objective is, the business may be asking either way and hoping either way that some of these things can be either expensed or capitalized as part of the building. So, for example, they might be hoping they can expense some of the taxes related to the building, so that to lower their taxes, their income taxes, and the brokerage fee. The question could be, well, can I write off the brokerage fee this year rather than capitalizing it and then expensing it? And those types of things can add up, and we got to follow the rules here in terms of what should be allocated. These are going to be part of the purchase and part of getting the building up and running, and therefore should be part of the capitalization of the building not expensed when paid. Then we're going to have land improvements. Now we've got land and then land improvements. Land is what it is. It's just going to be the land that the building is going to be on, and it's not something that's going to depreciate. Now, things we put on the land that are going to be permanent structures, like driveways, fences, shrubs, lighting, parking lots, those are all going to be things that we're going to say are land improvements typically. And so those are going to be the type of assets we have for land improvements. We're going to depreciate over the useful life of the improvements. And that's going to be important because land doesn't typically go away, but the improvements will. So whatever we do to the land, we're gonna if it's typically something that's going to like be permanently attached to the land or installed in the land in some way, that basically if you sold the land, you would still have the structures on it most likely, then those are going to be improvements, and those will deteriorate over time and therefore need to be depreciated, need to have the cost allocated. However, the land itself, once purchased, you don't really depreciate that. The cost is what it is, and it's going to be there for good. The land's not going to go away in a human lifetime, hopefully. So then if we have land, it's another category of property, plant, and equipment. What is included in the purchase of land? Obviously, the purchase price of land. Same principles are in play here. The title insurance, so that would be part of the cost of the land, the title insurance. The surveying fees, if there's any surveying fees, that would be in cost of the land and be capitalized. We've got the real estate commissions, that would be a cost of the land. And we've got the title search and transfer, also going to be a cost of the land and improvements. In this presentation, we will discuss lump sum purchases as it relates to property, plant, and equipment. When we purchase something like a building, we typically have one lump sum purchase for more than just the building here because the building is on the land, and if we're including the land, we purchased the land with the building. If there are any other lease improvements that we need to break out separately, then those two would be something that we need to break out in some way. This can be a little bit difficult given the fact that we have a lump sum purchase. A couple ways we could do this. We may take a look at the property tax assessments and see what the breakout was done there in order to assess property taxes. We can also take an appraisal of the property and use the appraisal in order to make this assessment. The problem with this, however, is that the appraisal doesn't always match the purchase price. The appraisal may not have taken place right at the purchase price. We may not have purchased for the appraisal amount. So how then can we use the appraisal in order to create an allocation, because that's the best thing we have in order to do so. Now, it's also important to note that we need to break these things out. For example, if we have a cost of $110,000 for the purchase of the store, which includes land, improvements, and building, we need to break these things out because they have different depreciable lives. One, we want to categorize them differently so that we know the value of the land versus the building. And two, we're going to allocate the cost over the useful life in different ways. For the most part, land doesn't depreciate, so whatever we apply to land will remain there forever, and whatever we apply to building will then depreciate over the life of the building. And that's a significant difference. So it really depends what our objective is when we make this allocation in terms of which would we rather have. We want to be as objective as possible, but just from the perspective of the company, if you wanted to look better, then you'd probably want to have land have more of the allocation, because the building's going to deteriorate over time. As it does so, the building will decline in value on the balance sheet. The balance sheet will go down, and will record expenses related to that deterioration, that called depreciation, bringing down net income. If, on the other hand, we want to make net income smaller for tax purposes, then we might want more in building than in land. We'd want to allocate this $110,000 more to building than land, because the building is going to be depreciated and that'll bring down net income, whereas the land will not. So if we have the appraised amount, if we have an appraisal of $35,000 for the land, $15,000 for improvements, $90,000 for the building, that totals up to $140,000. That, of course, different than the cost. The cost was only $110,000. So how can we use this $140,000 in order to allocate a different amount, $110,000? One way to do that is to use a kind of ratio, and this is going to be important. It's useful for many different areas, and so it's a really good concept to know here. You'll see it other places within accounting as well as other areas when we need to do some type of allocation or ratio analysis. So we've got the appraisal amount here, the 35 land, the land improvements 15, and the building 90 for an adding up to the total of 140,000. What we're going to do now is take the percentage of the total for each of these and use that percentage to then allocate the 110. So, for example, we'll take out the trusty calculator here. We're going to take the 35,000 divided by the total, 140,000. So that's 0.25 or 25% of the total. So that's 25%. If we take a look at the 15,000 over compared to the total 140,000, we get 10.7%, 10.71%. And then of course if we take the 90,000 divided by the 140, we get 0.6429. And if we add all those up, then we get the 100%. So that's going to be our key here. So we're going to just say, obviously, if we take the 25 plus the 10.71 plus the 64.29, we get the 100%. So that means we can use this allocation to allocate this amount. So we're going to allocate the cost now, or just multiply each one times the cost, 110. So 25% of 110,000 gives 27,500. 10.71% of 110 gives 11,786. 64.29% of 110 gives that 70,714 for a total of the 110. So if we add all that up, 27,500 plus 11,786 plus 70714 gives us our 110. So that's a very useful way to do this. So if we have some type of allocation method that doesn't quite allocate to the dollar amount we're looking for, we can still use it. We can still use the appraisal. What we'll do is we'll take the ratio of the amounts compared to the total. That'll give us the ratio that we can then multiply by the cost to find the proper allocation or an appropriate allocation. Hello, in this lecture we'll talk about calculating depreciation using the straight line method. We will be able to calculate depreciation using the straight line method, create journal entry related to depreciation, explain the effect of recording the journal entry related to depreciation on assets, equity, net income. So in the past we have discussed talking about the recording of depreciation, meaning how do we record the journal entry for depreciation. We have not yet looked at how to calculate that depreciation in a defined way. Now we're going to talk about the calculation of depreciation, but we always want to keep in mind that adjusting entry of what depreciation is. At the end of the day, it's going to be reducing the cost of the equipment and recording the expense over the useful life. So keep the bigger picture in mind as we drill down into the details of the calculation in this case. We're going to start off with the straight line method, which if you were to ask someone how to solve this type of problem, this would be the first method that would probably come to most people's mind. It's very commonsensical and makes sense. So let's see what we have here. In this case, we have purchase of equipment on January 1st costing $257,500, salvage value $20,000, useful life 4 years. First question then is, the problem is this: if we expense that $257,500 in the year of purchase, it will bring down net income, and that could distort our net income when we compare year over year, because we would have a reduction of this large purchase which hasn't been consumed yet, hasn't been used. So in accordance with the matching principle, we need to allocate that amount over the useful life, and in so doing, we will allocate it in such a way that net income will be more evenly affected and thereby make the comparability of the income statement a lot better. So that's the idea. Now, if we're going to say how are we going to do that, the first thing that probably would come up to people's minds is, Well, let's see how long this equipment is going to last, and let's allocate the cost over the useful life. In essence, that's going to be the straight line method. So the calculation is going to look something like this. We're going to say take the cost. We do have to then reduce the salvage value. So what is the salvage value? We have the 20,000 salvage value. That represents the amount of money that we believe we can sell the equipment for at the end of its useful life. So if we were talking about like a forklift or something, then at the end of the useful life, maybe the forklift is no longer operational. Maybe it's completely done for operation, or we don't need it. But even if it's done for operation, then we could still scrap it for metal or something like that. That's the salvage value. So that's what we need to depreciate it down to, because that is the amount that we believe that we can sell it for at the end of the useful life. So that will give us the amount that we're going to be depreciated. So what's going to happen is we bought it for this, we're going to put it on the books as an asset here, then we're going to depreciate it down to 37.5 over the useful life. And if we do that, then we'll be left with 20,000, which we believe we can sell it for at the end of the time frame. Once we have the amount that we want to depreciate it, we're going to divide it by the useful life. In this case, they gave us, of course, the useful life being 4 years, and the question that's going to come to mind is going to be, well, how did you come up to that 4 years? So we're going to have to, there's various ways we can think about the 4 years. Obviously, we're going to have to plan out how long we believe the equipment is going to be used for, and that's how we would, come up with the useful life for an accounting purposes. Notice that the tax code will differ. The tax code oftentimes will just tell us what the depreciation is in accordance with what type of category the item is in. But also notice that the tax code is not necessarily geared towards the best reporting in order to make the best decisions. So the tax code is geared for other types of things, such as stimulating the economy and this type of stuff. And therefore, there could be different types of accelerated methods. So the depreciation calculation for the taxes will be same concepts involved, but could differ greatly than the depreciation for the financial statements. The depreciation for the financial statements are what we're talking about here. The goal on the financial statements is to have the proper matching in order to have the best reporting, in order to make the best decisions. Therefore, the useful life should be the useful life that is most accurate in terms of what we believe the equipment will help us in the future in order to generate revenue. So if we do that division, we're going to take the 137.5 divided by 4. We have 59,375 per year. So that's what's going to happen. We're just going to depreciate it by the 59,375 each year, and at the end of that time period, we'll have accumulated depreciation of 237.5, and the cost will remain at 257.5, leaving us with a salvage value of 20. Let's see what that will look like then. If we look at a table in terms of the calculations, we can think of it in terms of a table, then we can think of it in terms of the trial balance and what it will look like in relation to other accounts. So if we think about it in terms of a table, we know that depreciation is what we just calculated. Then we want to think about the book value. The book value is going to be the cost less the accumulated depreciation. So we said we just calculated the 59,375 for the depreciation for this period. If we calculate the book value, then we're going to say that will be the cost, 257.5, minus the accumulated depreciation, which represents the depreciation over the useful life of the asset up to this point, which, of course, at this point is just equal to year 1 being the only year that we have done so far. And that will give us the book value. Notice what we are not doing is we're not just writing down the equipment itself. We are actually making a new account called accumulated depreciation. And the reason being is that unlike something like supplies, where we actually use the supplies, write down the supplies, and we can see the physical deterioration, in this case we know it's an estimate. We know if we bought a forklift, that same forklift is there after we wrote it down. It's not like we have less of a forklift, but we also know that the value theoretically is going to go down over time, and therefore we're telling our reader it's an estimate. Look, it's an estimate. This is what I paid for it. This is what it's gone down by in accordance with the estimate. How did we estimate it? Well, we'll tell you. We did the straight line over 4 years with a 20,000 salvage value. So if we look at the journal entry then, here's our same calculation. Here's our number in terms of a table. If we think of it in terms of context of the trial balance, this is a simple trial balance that we have the assets in green. This is before we record the journal entry. And we have assets, cash, accounts receivable, and then here's the accounts we're going to work on: equipment, accumulated depreciation. And then we have a liability, and the liabilities are represented by credits in this case with brackets. And we have the capital, we have the revenue less the expenses. And we can see that the debits that are non-bracketed minus the credits that are bracketed are 0. Therefore, the debits equal the credits. We also see that we have a net income of 100,000. That's income, not a loss. How do we calculate it? Revenue here, less expenses, no expenses at this time. The only expense that we're going to be looking at is depreciation, so that we can see the effect in that case. This net income is an arbitrary number. We're assuming that we earned 100,000 over this time period, so that we can look at the effect on net income for the transaction that will happen. Also note that the equipment is on the books already at this point at 257.5, which would be a debit to 257.5 when we bought it and a credit to cash or payable when we bought the equipment. So now if we look at the journal entry, then you would think that if the equipment was on the books here, that you would then write it down by the depreciation. You would think it would reduce the equipment. That's kind of what happens when we think about supplies. But remember that that equipment is still on the books, and therefore we don't want to write it down because we want to tell our reader, hey, it's an estimate. I want to tell you, the reader, two things. I want to tell you what I bought it for, and we also want to tell you what we wrote it down by. Therefore, it's kind of like we're cutting the T account for equipment into two accounts, like a 7 and an R. So we got the 7 on this side, the debit half of it, and then we're kind of putting the credits on another account over here. And that we're going to now call a contra asset. Notice it's still green, it's still next to all the other assets, but it has a credit balance represented by the brackets because it's really the reduction half of the equipment here. All right, so the adjusting transaction then is going to be, all adjusting transactions usually have one income statement account, one balance sheet account. We know the balance sheet account is going to be accumulated depreciation. We know the income statement account is going to be depreciation expense in this case. We know that expenses only have debit balances for the most part, and expenses generally only go up. So we're going to make them go up again by doing the same thing to it, which is a debit, increasing the expense, and therefore we're going to credit the other account being accounts payable. If we look at what happens when we post this journal entry here, then we can see that the accumulated depreciation is going to go from 0 up in the credit direction to 59,375, and we can see that the debit of 57,500 minus the accumulated depreciation 59,375 will equal the book value of the 198,125 that we calculated in our table being the book value. We can see that the depreciation expense went from 0 up to 59,375. What's the effect on net income? Well, it's the 100,000 that we assume we earned before this expense, less the 59,375. Revenue less expenses means that income went down to 40,625. If we look at equipment purchased in the year 2, so now we're going to say year 2, this is the table that we already had from the prior year in year 1. Then we're going to say the same calculation. We don't need to recalculate it. We know that depreciation is the same for each year, each of the 4 years. Therefore, we're going to say depreciation is once again 59,375. The cost is the same. The cost does not change. That's what we paid for it. The accumulated depreciation, on the other hand, is the prior year's accumulated depreciation plus the current year's depreciation expense. That's one way to think about it. Or it's the depreciation expense over the life of the asset to this point. So the 59,375 plus the 59,375 this way, or the 59,375 plus the 59,375 this way in this case, will give you the accumulated depreciation of 118,750. How do we calculate the book value? We take the cost less the accumulated depreciation, giving us the book value of 138,750. So let's look at that in terms of our trial balance. So if we look at year 2 now, this is where we started at the beginning of year 2, meaning that the book value is now the 257.5 less the 59,375, which is the book value here in after year 1, because that's we're at the beginning of year 2, and then we're going to post the transaction. So this is the year 2 before this adjusting entry is recorded. Then the owner's equity is including all of last year's income and expenses is rolled into the capital account, and then we're assuming that we earned another 100,000 in year 2. So this isn't the same 100,000 earned in year 1, it's the new 100,000. We're assuming we had the exact same earnings in year 2 so that we can compare year over year what has happened and what will be the effect of depreciation on it. And then of course we have 0 at this point in the depreciation expense. Notice we had to clear out the last depreciation expense to the capital account in order to start the new year. So the accumulated depreciation does not go down from year to year. It's a permanent account on the balance sheet. The depreciation expense is going to be cleared out at the end of each period, in this case the end of each year, in order to start the counting again in the next year. We're assuming that we earned 100,000 once again in year 2, as we did in year 1. Now we're going to record the transaction, and of course the transaction is the same adjusting transaction. Every adjusting transaction has generally one balance sheet account, one income statement account. Income statement account is going to be depreciation expense. Expenses only go up. We're going to make it go up by doing the same thing, which is a debit. So we're going to debit depreciation expense. Then we're going to credit a balance sheet account, that account being accumulated depreciation, and we're going to credit it by the 59,375. And so if we look at the effect of that transaction, the depreciation expense is going to go from 0 up to 59,375 in the debit direction to 59,375. What's that do to net income? The 100,000 minus the 59,375 is the 40,625. Again, it's income, not a loss. The brackets represent credits winning. On the balance sheet side, the cost remains the same. Now we got 257.5, and the accumulated depreciation went up in the credit direction for a contra asset account, being an asset account that has a credit balance rather than the normal debit balance for asset accounts, from 59,375 in the credit direction. The same thing makes it go up, so a credit and a credit made it go up in the credit direction to 118,750. The debit of the equipment, the 7 side of the T account, minus the credit of the accumulated depreciation, the R side of the split of the T account that we made, will give us the book value of the 138,750. All right, so then if we take a look at the next year, now we're at the end of year 2. This is where we were at. Year 3 will look much the same in the straight line method. We're going to have more depreciation expense, same amount on the depreciation expense. The book value calculation cost will be the same cost that we've had, of course, and the accumulated depreciation is going to be last year's accumulated depreciation plus the current year's depreciation expense, or you can think of it as the depreciation expense throughout the life up until this time. So the 59,375 plus the 59,375 plus the 59,375 will give you the 178,125, or prior year's accumulated depreciation 118,750 plus the current year's depreciation expense 59,375 will give you the 178,125. If you subtract these out, then you'll get the book value of 79,375. What you want to be careful of when questions are asked on these types of problems is they can ask you anything. They can ask you any of these numbers here. They can ask you what is the depreciation expense at a current year, what is the cost. They probably won't ask you that as much, but they could ask you what the accumulated depreciation is at any given time, or what the book value is. So students often get good at calculating one or the other, getting kind of to a shortcut so that we can calculate one piece well. But oftentimes a problem is going to need all the information, and therefore it might be good to set up the table in some way that you can just plug in numbers in accordance to this. And if Excel, of course, is great for doing that. If you set up an Excel worksheet that basically will calculate all of the stuff with minimal input for a straight line method problem, then that would be very helpful. All right, so then we're going to say the equipment will look like this. Here's our table up here. If we post the journal entry, once again, it'll look much the same. The journal entry now looks like this, but if we start out year 3 before we post the journal entry, note what it looks like. We have the equipment before, which is the same value. We have the accumulated depreciation, which was the accumulated depreciation for year 2, giving us a book value of 138,750 before we record this. And we can see that the capital account now includes the net income from the prior year. Once again, we're assuming that we made another 100,000 in year 3. This is not the same 100,000 that was in year 2. this is what we have earned in year three, assuming our performance was the same and everything other than the expenses, which is, we're only going to use one right here. And then the accumulated depreciation is now 0. Why? Because it got closed out last time in the closing process to the capital account. So once again, remember that the accumulated depreciation goes up and it never goes away until we sell the item, whereas the expenses is a temporary account that gets closed out to the equity section after every period. So if we record this, it's an adjusting entry. We're going to debit an income statement account, this account being expense. We're going to increase the expense because expenses generally always go up with a debit. So we're going to do the same thing to it, making the expense go up. So we're going to debit depreciation expense, and we're going to credit a balance sheet account, that balance sheet account being accumulated depreciation. And if we post that, then we say that accumulated depreciation has a credit balance. We're going to credit it, making it go up in the credit direction. And that is actually a contra asset account because it's an asset in with all the other assets, which has a credit balance, which is contra to the normal debit balance of assets. And then if we calculate the book value, 257.5 minus 178,125 would give us the book value 79,375. Then if we take a look at the expense goes from 0, goes up by the debit here, and goes up to 59,375. What's the effect on net income? Brings it down from 100,000 down to 40,625. So let's do this one more time. We're going to go to year 4, the final year, and then we'll wrap this up. So year 4 looks much the same. We've got another expense of 59,375. The cost 257.5 is the same. The accumulated depreciation is prior year's accumulated depreciation of 178 to 125 plus the current year's expense 59,375, giving us the 237.5. Or you could say it's all the depreciation expense over the life of the property. 59,375 plus 59,375 plus 59,375 plus 59,375 will give you the 237.5. The book value then cost 257.5 less the 237.5 gives us 20,000. We've seen that somewhere before. 20,000. Where have we seen that? That is the salvage value. So remember, we thought that at the end of its useful life being 4 years, we have now ended the useful life in accordance with our estimate. Then we should be able to scrap it for 20,000. So you might be asking, what happens in year 5 if the thing is still in operation? What happens if we're still using this thing next year? Do we keep on depreciating it because we're still using it? And the answer generally is no. We don't generally keep on depreciating it. And it's easier to see that if we had a case where there was no salvage value. So let's say that the salvage value was low or immaterial, and we just said we're going to write it down to 0 instead of the 20,000 in this case. You can see that if we kept on depreciating it, even if we're using it, in the next year it would make no sense to have an asset like a forklift on the books that's not only written down to 0, but actually has a negative value. It's worth negative 20,000. That wouldn't make any sense. So we cannot take it below the floor. The floor, obviously, if there was no salvage value, would be 0. If there is salvage value, the floor is the salvage value. Now, there is a question as to whether if our estimate is so far off that it's immaterial and we need to fix it, then we could have the issue of revaluing the equipment or adjusting the depreciation on it and extending the useful life at some point. But that not being the case, what we'll do is we'll say, okay, the estimate wasn't perfect, but we've expensed it, and what we cannot do is go past the amount of the value of the cost of the equipment. We can't expense more than we paid for the equipment. So if we look at this in terms of the trial balance, once again we have the same thing. We're in year 4 where we had the book value before at the beginning of the period or before the adjusting entry being the 79,375, which would be the 257.5 minus the 178,125. And note that the accumulated depreciation is accumulating upwards because it's a permanent balance sheet account as opposed to the depreciation expense, which is 0 before we record the transaction because the prior transaction was closed out to the equity section is now part of this 449,375. And of course we have net income. We're assuming it's the same net income, same earnings this year that we had last year. Again, it's not the same amount. Of course, we earned 100,000 in year 3, and now we're assuming we earned another 100,000 in year 4 just to see some context of the transaction. We record the transaction, looks much the same. It is much the same. We debit the $59,375 to depreciation expense, making the expense go from 0 up in the debit direction to $59,375. What happens to net income? 100,000 minus 59,375 brings it down to 40,625. The accumulated depreciation goes from 178,125 up in the credit direction, because we're doing the same thing to it. Credit and a credit makes the credit go up to 237.5. And now if we take the 257.5 less the 237.5, that is 20,000. So we can see on our trial balance that we have a book value remaining. Now, I do want to point out that, of course, we're talking about one piece of equipment here, and a lot of companies, of course, will have lots of equipment, and we will then have to have this number will be grouped. These two numbers will group much equipment in it, and we'll have to have worksheets that will basically record this depreciation and back up this depreciation schedule. So this is a simplified example so that we can see the context here. Notice that these numbers in reality will often have lots of things involved in it, and we'll have very detailed ledgers that will do the calculations of the depreciation so that it will back up these numbers. And we'll often have to have, of course, two of them, one for taxes possibly and one for the books, of course, and maybe even more than that depending on different tax regulations and our needs in that case. So if we look at this in terms of year over year, so I'm just going to put the ending trial balance for year 1, year 2, year 3, year 4, so we can compare this and see what has happened to it. We see that the depreciation on the table remains the same each year. We could see that on our trial balance. It remains the same each year. Each year we're going to depreciate the same amount. We can see that the accumulated depreciation goes up at a fixed rate, meaning it goes up at $59,375 each year until the last year, year 4, in which case that's the end of it, and it will not go up in year 5 because we have fully depreciated it down to the salvage value. And we can see that, of course, in the table as well. What happens to the book value? It goes down at a constant rate. So it's going down by the $59,375 in a constant rate, leaving us with the salvage value of the $20,000. What happens on net income? It's an even effect on net income. Now remember, we're assuming that we earned $100,000 each year. This is not the same $100,000. We're assuming that each year we performed exactly the same on the revenue, and the model is showing that we only have one expense. So we can isolate that expense and see what would be the effect if that were the case in net income. Obviously, in reality, that is impossible. That would never happen. But in the model, we're earned the same $100,000 each year, and the only expense we have is this depreciation. So the effect is the reduction to the net income in the same fashion. So we have the same net income, all else the same, other than depreciation, then net income would be the same because we evenly allocated it. Now later that will not be the case. So I'm going to just show you the later calculations that we'll have. This is our allocation here. You can see the even allocation and the net income effect. Next time we're going to go into the double declining method, which is the idea that we should be able to depreciate more in the first years than the last years because the equipment will be more efficient in beginning years rather than later years. So there is, some reasoning that's appropriate in this case to do this type of method. So we're going to say we should be able to front load the depreciation, and thereby what would that do? Well, that would reduce the depreciation that would increase the depreciation, reduce net income in the beginning years, and it would increase net income in the later years. So that's what we're going to take a look at next time. You notice that in year 1, up here, we have an income of $40,000, and if we use this method, we got a loss of $28,750. So that's a big difference. Then in year 2, we have a gain of $35 under this method, $35,625, as opposed to $40,625. Then the reverse happens. We have $67,815 under double declining, and the same $40,625, and then income goes up a lot more. If you look at the life of these two, we end up with the same place, meaning we end up with a book value of $20,000 at the end. We end up depreciating over the life of the equipment under any method we use, the same $237,500 to leave us with that $20,000. But there's a big difference in when the depreciation happens, we call that a timing difference. So over the 4-year period, there's no difference after the 4 years is over. But within that 4-year period, there's a big difference. So the question could be, well, why do we care? Why do we care about that if they're basically the same in the end? And the answer is that, there's going to be a lot of effect on our comparison of the financial statements. So for the accounting purposes, we want the financial statements to be as accurate as possible. Theoretically, that's our goal. So the accounting principles would say, well, which one of these methods are actually the most accurate? And there is an argument to say that the double declining or some kind of accelerated method is more accurate because it would give us more depreciation, more use in the first years than the later years. But there's also if we're talking about a tax incentive, note that if we're jumping to the tax code, we have the reverse incentive. Notice that if we're trying to look good, which we usually assume that we want to do for financial statement purposes, this makes us look bad at the beginning years and better at the ending years, which for financial statement purposes is probably not as much what we want. For tax purposes, that is more kind of what we want, because if we're able to take the deduction today, we would rather get the tax dollars today and then in the future. So for taxes, clearly, if a business had a choice, which they do have less choice because the tax code basically dictates what our depreciation options will be in a different way than generally accepted accounting principles. But if we had the choice, we would want to depreciate usually more in the first years than in the last year on taxes. When we think about our financial statements, then companies often have an incentive to look better in the current years, so they might have an incentive to use a straight line method to look better in the current years. But the ultimate goal of the financial statements is to do what is most accurate in terms of comparing year over year, and there is an argument for an accelerated method being better at that. Now, if we wanted to take more time to be more accurate, we might try a different type of method than these two. We might say, hey, why don't we use a different type of base rather than just time? And it's similar to if we were trying to figure out the value of the car, the depreciation of a car. Should we just take the car and divide it by its useful life? Or should we use something that might be more accurate, like taking the mileage of it and using mileage rather than time to depreciate the car? A lot of people would say, well, that would be more accurate. Neither one of them are perfect, of course, but that would be the units of production we'll talk about next time, in which case, and we'll talk about that later, but in which case, now we're going to say, well, instead of just depreciating over time, let's say how much of units that this thing is going to produce. So if we're talking about a printer, and we know that it's going to print so many pages over its useful life, that's what the warranty says, then we can divide the cost by the number of pages, and then we can see how many pages were printed over the certain time period and depreciate in accordance with that method, which would usually be considered to be more accurate. What's the problem with that method? That means we got to count the pages and then depreciate it, which takes more time to do so. So those are the pros and cons between these three. Note that in this example, if we did it with the more accurate method, which we would assume that to be more accurate, we are showing that the expenses truly are more front-loaded, meaning we're getting more use out of it in the beginning years than the later years, and that would kind of make sense, and that would support an accelerated method. So we are now able to calculate depreciation using the straight line method, create journal entry related to depreciation, explain the effect of recording the journal entry related to depreciation on assets, equity, and net income. Hello, in this lecture we'll discuss calculating depreciation using the double declining balance method. We will be able to calculate depreciation using the double declining balance method, create journal entry related to depreciation, explain the effect of recording a journal entry related to depreciation on assets, equity, and net income. So you'll recall from prior periods that we have talked about in the adjusting process the recording of the adjusting entry being for depreciation, being a debit to depreciation expense, a credit to accumulated depreciation. We had not talked about how to calculate that depreciation at that time. That depreciation was just given to us and we were thinking about the concept of that adjusting process, what it is doing, reducing the value of the equipment on the books or the book value and recording the expense over its useful life. We then have looked at the straight line method, which is probably the first method we want to look at because it's usually the first thing that we will think about when we think about this problem related to equipment. What is the problem? Well, if we think about an equipment like this, such as equipment that we purchased for $257,500, and we have a salvage value in this case of $20,000 and a 4-year useful life. Now, if we just think of the cost, the question is, well, if we bought the equipment and we expensed it, then the expense would lower net income in the year of purchase, and that could really distort the net income, meaning it will make us look a lot worse in the year of purchase than later years, which may not seem correct if we think about it, because that equipment is going to help us in future years, in this case 4 years. So it doesn't really make sense for us to look worse in year 1 of purchase and a lot better in year 2 because we just happen to purchase this piece of equipment in that year that will help us through the next 4 years. So the logical thing to do would say, well, let's allocate it over its useful life, which in this case would be 4 years. And the straight line method would basically take this amount minus the salvage, the amount we're going to get at the end, divided by the 4 years, and then just straight line over, meaning the same amount of depreciation will be expensed each year of its useful life. Now, that would be the most common sense thing to do. Now, there is an argument to say that, well, maybe we should depreciate more in year 1 than in year 4, because the equipment being in year 1 is usually more productive in that year than in later years, and therefore we want to depreciate more in year 1. There could be other incentives for us to want to do that. If we do that, of course, it'll generally make us look worse in year 1 and better in the final years. But we'll talk about that more in the future. In terms of just the accounting practice, in terms of just best practice, in terms of reporting the financial statements, the question is which one of the two will be better in terms of reflecting reality. Reality being, is it true that more depreciation would happen in the first year than the later years? That's the assumption that's being made in the double declining method, which we'll talk about in this calculation. So double declining method, we're going to take the cost, we're going to subtract from it, we're going to divide the cost by the number of years in the useful life. What we're first going to look for is the rate of depreciation if we were on a straight line method, not taking into consider the salvage value. So I'm going to calculate this rate 2 ways. I want to calculate it the long way here and then give you a shortcut to do it, just so you can see what we are calculating. So if we take the cost divided by the number of years in the useful life being 4, that will give us the straight line depreciation if there was no salvage value. So we're just going to allocate evenly over the 4 years down to 0, in this case assuming no salvage value. So keep that in mind, that salvage value is a factor that confuses people between the two methods. We will have the salvage value as a factor, but it will come in at a later time. Then we're going to divide that by the cost, which is the same cost up here, of course, and that will give us our straight line percent if there was no salvage value. So what we're trying to do is say, okay, if we took the cost and multiplied it times what percentage in order to get that straight line rate, meaning if it's 4 years, of course, if we take the $257,500 and multiply it times 25%, that's how much we're going to depreciate each year to bring it down to 0 at the end of its life. Also note that, of course, I put this in the format of a percent. If you put this into a calculator, this number 64,375 divided by 257,500, you'll come up with 0.25, which of course is calculated into a percent being 25%. Then we're going to double it because it's the double declining method. So we're just going to multiply times 2, and that will give us the double declining rate. So what are we going to do with the double declining rate? We're going to take the cost and multiply it times the double declining rate being 50% rather than the straight line being 25. Now, this will cause confusions later in that a lot of people will start to think that the first year all we have to do is double the depreciation, which would be the case just for the first year if there was no salvage value. But if there's salvage value, not necessarily the case, and you want to be careful with things that work sometimes but not all the time because then you'll start to learn a process that is not always applicable, and that will of course cause problems. So notice that most questions will not even ask for the first year. They're going to ask for like the second year because the second year is a little bit more confusing to calculate, and you can't take some of these shortcuts that don't work really in the second year. So keep that in mind as you go. You kind of want to set up a system to have the longer calculation and have it ready, have your calculation format ready. All right, so this is another way to calculate that same thing, and obviously a much shorter way. So I want you to see the comparison in the long format to see how we come up with that straight line rate, why it's a straight line rate, and how do we double it, of course. The short method is just to take 1 divided by the number of years, which in this case is 4. So if it was a 3-year property, we'd just take 1/3. If it was a, if it was a 7-year property, we'd take 1/7, and that, of course, would give us that same 0.25 or percentage 25%. Then we can double it, and we'd come up to our 50%. Just remember, what does that 25% mean? It means that if we took the 257.5 times that rate, that would be the straight line depreciation that we would depreciate over the useful life each year in order to depreciate it down to 0, not down to 20,000. That would be the straight line rate if there was no salvage value. Then we're going to double it. Once we have that, then we can start calculating depreciation. Now it's going to be a little bit longer of a method because now we're going to have to calculate depreciation for each year, and it will differ. The expense will not be the same. So in the first year, we're just going to take the cost, that's what we bought it for, of course, times the double declining rate, which we calculated to be 50%, and that will give us the 128,750 for the depreciation in year 1. So year 1's pretty easy to calculate once you get the rate, and so just make sure you have a system to get the rate down, and then year 1, calculate that out. Then if we looked at our table, same as we looked on the straight line, but now the depreciation expense for the first year is much higher. It's 128. It's not exactly double, because remember that salvage value kind of throws that off, but it's much higher, and then the cost is going to be the cost less the accumulated depreciation, which gives us the book value of 128,750. And of course, we're taking 50% being for the 4-year property, so we're left with a book value of half after the first year. So that's a much larger number. If we look at it in terms of the journal entry, again, the format of the journal entry is going to be much the same, but of course the number has now changed. And if we look at a trial balance, we've got year 1. I'm going to say that we have cash, receivables, and then here's the equipment that we put on the books at the cost, 257.5. The accumulated depreciation before this adjusting entry being 0. We've got a liability of 10,000, liabilities represented by brackets, and it's orange. And then we've got the capital account being a credit with brackets, and we have the revenue being a credit with brackets. The expense has not yet been recorded for this time period. That's what we're going to do. If we take the debits, non-bracket numbers, minus the credit bracket numbers, we would come up with 0, meaning the debits and the credits are equal. We are in balance, and we can see that the sales credit minus the expenses, there's none there left, is the 100,000. So this is 100,000 is assuming that all else equal, all we've made is 100,000 in this time period. The only expense we are going to consider is depreciation expense, so we can see the effect of it on this transaction. If we record this adjusting entry, all adjusting entries have one balance sheet account, one income statement account. The income statement account will be depreciation. It's an expense. Expenses have debit balances. We're going to make it go up by doing the same thing to it, which is another debit. Debit depreciation expense. Credit the balance sheet account, which in this case is accumulated depreciation. Accumulated depreciation is a contra asset, has a credit balance. It's going to go up by doing the same thing to it, which in this same case is a credit. So if we post that, then we can see what happens. Depreciation goes from 0 up in the debit direction to 128,750 from posting this transaction here. And what happens to net income? 100,000 less than 128,750 brings it down to a loss. We're losing in net income by 28,750. So revenue is actually good. The credit is good, less the expense, which kind of is bad, means we have a loss, 28,750 in year 1. And the credit is going to be going to the accumulated depreciation at 0 up in the credit direction to 128,750. Note that we have a credit here in an asset account. That's called a contra asset. So why is it a contra asset? Because normally assets have debit balances and this one has a credit balance. Why does it have a credit balance? Well, because we took the equipment account and instead of writing down the equipment account directly, we kind of split the equipment account between a 7 and an L. We turn the T into a 7 and an L in some ways because we want to tell our reader two things. We want to say, hey, this is what we bought it for. This is the estimate of what it's gone down by. Therefore, the book value is the debit less the credit. You can calculate that out. It will come out to 128,750. And we do that because the equipment doesn't go away, unlike supplies, where we can physically see that the supplies go physically down, thereby backing up the physical deterioration. The equipment, of course, we cannot see, if we have a forklift, we have one forklift still. It's not like we have less than one forklift, but we do know that the value over time should go down, and we need to allocate that cost over the time in some way. So if we look at year 2 then, we're going to do the same type of calculation. We're going to go to year 2, and we're going to take the cost less the accumulated depreciation prior to the current year. So the accumulated depreciation we had from last year is the depreciation expense up till that point, which was 128,750. So the book value before the current year, before we calculate the depreciation for year 2, is 128,750. And then we're going to multiply it times the double declining rate, being the 50%, which we calculated first off, and that will give us depreciation for year 2 of 64,375. If we compare that, here's year 1, and then now here's our year 2. So year 2 depreciation went way down, which is not what happens under straight line. That's what happens in double declining. We're front loading the depreciation in the first year, far less in the second year. Cost is still the same. Book value calculated by the cost less the accumulated depreciation. So the 257.5 minus the 193.125 gives us book value of 64,375. Now, if we look at that in terms of, here's our 64,375 in terms of our accounts, we can see at the beginning of year 2 or year 2 before we record the adjusting entries, we have our cash or receivables. The equipment's still on the books at 257.5, and the accumulated depreciation is 128,750, what it was after year 1. And then we can see down here we're going to have the same income, meaning that not the same income we made in year 1, but we're assuming we made another 100,000 in year 2. We performed exactly the same in this model, and then the depreciation expense is 0. Why? Because last time's net income, the income statement accounts being revenue and depreciation, got closed out to capital last year, and now we're starting at the temporary account of 0 on the income statement accounts, whereas on the permanent account for the balance sheet, we still have the 128,750 in it. The journal entry is going to be a debit to depreciation expense. It's an adjusting entry, so we debit the income statement account, making it go from 0 up in the debit direction to 64,375. What does that do to net income? 100,000 revenue less the expense brings net income down from 100,000 to 35,625. This is income, credit represented by brackets. That's obviously recorded here with this journal entry. Then we're going to credit accumulated depreciation. So accumulated depreciation is the balance sheet account. It had a credit balance of 128,750. We're going to do the same thing to it. A credit and a credit makes the credit balance go up in the credit direction to 193,125, same as our table. If we take the debit 257.5 less the credit 193,125, we get the book value 64,375. If we go to year 3, now we're going to have to do the same type of calculation. We're in year 3 now. We got the cost less the accumulated depreciation. The accumulated depreciation we are going to have to get from this table or some kind of calculation such as that. So note that you're going to, when you set up a problem like this, they're probably going to ask you for at least year 2 or year 3, and you really want to set up a fairly well-organized table so that you can then go back and say and do the later calculations and calculate not just the depreciation expense, but also the accumulated depreciation and the book value. So if you get a format set up, a template that could format any double declining problem and then just be able to change the numbers, that will help you a lot. You want to format it so that you can calculate any of these numbers, meaning the depreciation for any time period, the accumulated depreciation for any time period, and the book value so that you're ready for any type of question that they could ask. So we're going to have to get that 237, and that's going to be the cost less the accumulated depreciation, which is the 193,125, gives us a book value before the year 3 depreciation is calculated. Then we're going to multiply that times the 50%. That will give us the depreciation for year 3. It's now going down to 32,188. So if we look at our table, here's where we were at the end of year 2. Year 3 looks like this. Depreciation is now, of course, going down. It's front loaded. At the end of the day, it'll be the same as it was in the straight line, but you can see that through the period of the 4 years in this case, it is much different. The cost remains the same, and the accumulated depreciation is now the prior year accumulated depreciation plus the current year's depreciation expense to get the 225,313. Or you can calculate depreciation up through the useful life. 128,750 plus 64,375 plus 32,188 will also give you the 225,313. So if you mull that over, the book value is the cost less the accumulated depreciation, 257.5 minus the 225,313 gives us the 32,188. If we look at that in terms of the table and the chart of accounts, then we can see the value of the equipment's on the books for the 257.5. The accumulated depreciation before this adjusting entry is 193,125, which is what it was in year 2. If we subtract those out, we get the book value of the 64,375. The 257.5 minus the credit of 193,125 gives us the book value of 64,375. We can see that the revenue, we once again are assuming that we earned the same amount of revenue in year 3 as we had in year 1 and year 2. It's not the same revenue in that it's the same number. What happened is we performed the same in year 3 as we did in the prior years in this model, so that we can have the easiest comparison of what we're focusing on, which is depreciation expense. So the only expense in this model will be depreciation expense. It is now 0 before we record the entry. Why? Because years 1 and 2 got closed out in the closing process to the equity section, and therefore net income is just the 100,000 that we earned in year 3. So then if we record the transaction, it's an adjusting entry transaction, which has one balance sheet account above the blue line, one income statement account below the blue line. The income statement account is the depreciation expense. Expenses have debit balances. They generally only go up. We make this one go up in the debit direction by the calculated 32,188. So we debit the 32,188. We credit the other account. What will the other account be? It's going to be the balance sheet account, accumulated depreciation in this case. If we post that, then we can see the depreciation goes from 0 up in the debit direction to a debit of 32,188. What does that do to net income? Brings it down 100,000 revenue less the only expense that we are looking at in this case of depreciation expense being 32,188, bringing net income down to 67,813. Once again, this is revenue. The revenue is good. The revenue has a credit balance minus the debit gives us the 67,813. The equipment, the accumulated depreciation goes from a credit 193,125 up in the credit direction by the 32,188. We're doing the same thing to it. A credit and a credit makes it go up to 225,313. What does that do to the book value? The book value is the debit half being the equipment of 257.5 less the credit half being the accumulated depreciation 225,313, giving us the book value of 32,188. Once again, why don't we just combine these two accounts? Because we're trying to tell our reader that it's an estimate, and I want to tell the reader what the cost was plus what we estimated the depreciation to be. If we combine these two accounts back into a T rather than a 7 and an R, which is what we have here, the 7 debit half plus the R, the credit half, if we combine them together, we will not be able to show our reader the two numbers and give them both the cost and what we've depreciated it by. So now let's take a look at year 4. Now year 4 is the final year, and whatever the final year is, which happens to be year 4 because that's what we determined the useful life to be, will be strange under the double declining method, and that is because the double declining method is just an estimate. So this really disturbs a lot of people. A lot of people that like math and like accounting want things to work out perfectly. And notice that in accounting, a lot of things are estimates because we're estimating the value of things, and it's not a perfect estimation because obviously no one has a crystal ball. And therefore, this estimate, the way the double declining balance works, is not perfectly works out in mathematically, meaning the final year, whatever that year may be, in this case year 4, we'll basically need to plug in whatever we need to plug in order to bring that final balance down to the salvage value in this case. So just like in the straight line method, we said that there was a floor to the amount that we're going to depreciate. In the double declining method, we have the same floor, and it's easiest to see if there was no salvage value. If there was no salvage value and we just thought we're going to depreciate the thing down to 0, and then the book value will be 0 and we will stop, because it does not make any sense for us to depreciate something and have a negative value for a piece of equipment, then obviously we would have to stop at 0, and that's the idea here. The double declining method doesn't work out evenly in that it doesn't exactly stop at 0 if we do the same calculation that we had done in the past. So if we took the prior book value times 50% in the final year, it wouldn't exactly leave us with 20,000. That's the problem. In this case, we want to be left with just 20,000. That's the floor instead of 0, because that is the salvage value. What is the salvage value? That represents the amount that we believe that we can sell the scrap or the equipment for at the end of the useful life. So if the forklift, even if the forklift is completely unusable at the end, we should still be able to scrap it, or we believe we will be able to scrap it for a value of 20,000. Therefore, we need to stop depreciating until the book value reaches 20,000 and not go any lower than that. So we have to do a slightly different calculation in year 4. Now notice in practice that if you're doing a multiple choice question, they may not always ask for the final year's calculation, because you'd have to do that takes a lot of work for a multiple choice question, which is usually, so notice that you might not always be asked for the final year in a multiple choice type format, but you want to be aware that the final year is a different type of calculation. You want to be aware of the fact that you can't calculate something below the salvage, or you certainly can't calculate it below the 0. You can't have a book value of negative. So the way we're going to do that, then, we can take the cost less the salvage value, and you'll remember we did this in the straight line method, and that will give us the amount that we want to depreciate over the useful life, which in this case is 4 years. So if it costs $257.5 and we want it to end up as a book value at the end, which will be the salvage value of 20, that means then we have to depreciate over the life $237.5. Why? Because the $257.5 costs less the accumulated depreciation that we want to be at the end of $237.5 will leave us at the floor of the salvage value, the amount we can sell it for, of 20,000 in this case. So this is where we want to be. We want accumulated depreciation to be here as of the end of the last year, which is year 4 in this case. Where are we at now? Well, if we look at the accumulated depreciation before year 4, we are currently at $225,313, and we want to be here. So that means that we're going to subtract these two out, and that means that we need depreciation in the final year of $12,188. Why? Because the $12,188 will bring us to the accumulated depreciation total throughout the life, being 4 years, of $237.5. That's what we need in order for the book value of the cost, $257.5, less the accumulated depreciation, will now be $237.5 to leave us with that book value of 20,000. Remember, in year 5, we're going to stop. We may not have lost the forklift. If it's a we still have the equipment. It may still be in use, but we will not allocate a cost below the salvage in this case, and we certainly cannot allocate any more cost below the value that we paid for the equipment. So there could be a misstep in terms of our calculation and our estimation, and if it's a large misstep, then we may have to say that there was an error in the estimation and re-estimate it. But most of the time, like, more likely what's going to happen is, even if we're still using the equipment, it will have a zero value. We have already allocated the cost. We can't allocate any more cost than we paid for it. And so therefore we're just going to leave it at zero at that time, or in this case, at the floor of 20,000. So equipment purchase on January 1st. So if we're at year 3, the final year then will look like this. So now we have the depreciation of 12,188 that we calculated. We see the front loading of depreciation now going down throughout the 4 years. We can see that the cost remains the same. And we can see the accumulated depreciation will now be calculated by last year's accumulated depreciation plus the current year's depreciation expense, bringing us to the 237.5. Or we can say let's calculate it by adding up the depreciation over the useful life. Year 1, year 2, year 3, year 4 will be the 128,750 plus the 64,375 plus the 32,188 plus the 12,188 will also give us the accumulated depreciation as of the end of year 4 being 237.5. If we take the book value, the cost, the 257.5 less the accumulated depreciation 237.5, we're left with the book value of 20,000, which is what we want to be left at. Why? Because the 20 value is the salvage value. That's the floor. That's what we believe we can sell it for. So let's see what happens if we do that in terms of our trial balance. Remember the trial balance, here's our 20,000, here's our worksheet up here. Before we do this adjusting entry, we have equipment of 257.5, we've got accumulated depreciation of 225,313, and we have then a book value of the 32,188. We have the capital account here, we have the income. We're assuming we performed the same in year 4 as we did in year 3, so we earned another 100,000. Holding all else equal, the only other thing we're going to look at on the income statement will be the depreciation expense, and therefore it's 0 at this point before we do the adjusting process. Why is this 0 when this has a credit of 225,313? Because this is a permanent account and this is a temporary account. The income statement account closed out to the capital section, to the equity section, and therefore it's 0. We earned another 100,000 in year 4. And now we're going to record the transaction. It's an adjusting transaction, which has one balance sheet account, one income statement account, depreciation expense. Depreciation expense is going to go up in the debit direction. Therefore, debit depreciation expense 12,188 by the calculation we did up here. Credit then the balance sheet account accumulated depreciation by the 12,188. If we post that then, the debit will go here. Depreciation expense goes from 0 up in the debit direction to 12,188. Effect on net income, revenue less the expense brings net income down to 87,813. Revenue less the expense down to 87,813. That is revenue. That's not an expense. Revenue is winning. The credit's winning over the debit expense. So that is revenue, not a loss. Then on the accumulated depreciation, we have a credit balance before of 225,313. It's going up in the credit direction by the 12,188 to a credit and a credit are the same thing, making it go up to 237.5. If we take the book value, 257.5 less the 237.5 accumulated depreciation, we get 20,000, which is the salvage value. We're going to stop there because we believe that we can sell it for the salvage value. That is the floor. We can't bring it any lower than the 20,000. And again, even to make the point more clear, if the salvage value was not there, if we just depreciated it down to 0, even if we're still using it, we cannot depreciate it below the cost, because the whole idea is that we are allocating the cost over the useful life. We can't record an expense that isn't part of the cost. If we're still using it, what really happened is our estimate was off, and we should have estimated it over a longer life than we did. So we could either go back and try to fix that, but more likely, if it's not a very substantial or material difference, we're probably just going to leave it at that 0 basis, tell the reader, hey, we still have this piece of equipment, but it's fully depreciated at this time. You know, it's still on the books, it's still possibly in use, but we've already allocated the cost fully out. Also note that we're looking at this in terms of one piece of equipment, and in real life, of course, there'd be many pieces of equipment, and this account would need to be backed up by a depreciation schedule with those different pieces of equipment, calculating their rates over this fashion. And so much like the accounts receivable account, which will be backed up by a subsidiary ledger by a customer, we're also going to have to back up the equipment account by the type of equipment, when it was purchased, how much, what's its useful life, how long has it been depreciated. So that is a time-consuming area to do that. That does take a good deal of work in order to set that up. If we look at the comparison, then we can see that year 1, year 2, year 3, year 4. We can see that the cost is the same all the way across, whether we do it in our calculation method here or within the trial balance. We can see that the accumulated depreciation then is going up in not a straight fashion. It's going up at basically a decreasing rate. Why? Because we front loaded the depreciation. So all the depreciation, a lot more happened in year 1 than in year 4. If we look at the expense, we can see that a lot more happened in year 1 than in year 4. What's the effect on net income? Well, in year 1, if we're assuming, once again, holding all else equal, assuming we made $100,000 each year, then the expense is the only effect that we're having other than the revenue of $100,000. And the expense in year 1 actually resulted in us reporting a loss, even though there's no cash related necessarily to this year 1 equipment. We could assume that we paid for it in year 1, but we could have bought it on account or some other way, and it's actually making us have a loss because we front loaded it. And then we have income in year 2, more income in year 3, and more income in year 4, assuming once again the same amount of revenue. The only difference, the only change in this case being the difference in the depreciation expense caused by the double declining method. If we look at the comparison of the methods being straight line and double declining and units of production, then we can see under the straight line method, remember that if we used the straight line method, we would have the same amount of depreciation over the useful life. And the net income effect then would be that we would have an even net income over the useful life if all else was equal and we made $100,000 in each year, and the only changing factor being the depreciation expense. Whereas, of course, down here we just looked at that we have $100,000 and the depreciation is front loaded, and therefore we have a loss, and then we have income in later years. The effect over the 4-year period, because it's just a timing difference, is that we end up at the same point in time at the end of the time frame of 4 years as we would either method. So that means that at the end of the time frame, we're left with a book value of the $257.5 minus the $237.5, $20,000. We're left with the book value of the salvage value. Over the 4-year time period, we depreciated the same amount. So you might think, again, why does it matter if I use one or the other? At the end of the day, it's the same thing, isn't it? And at the end of the day, it is kind of the same thing, but there's a substantial difference between those time periods. So if I was to compare year 1 and year 2, the question is this a fair comparison? Should I be saying that I actually have a loss in year 1 and I have revenue in year 2 simply because this piece of equipment was allocated more in year 1 and less than year 2? Or is it more appropriate for us to say that we had an even distribution because we used the same piece of equipment for year 1 and year 2? And an argument can be made on either side of that. The even allocation would say, well, we're still using the piece of equipment. An argument for this method would be the accelerated method would be that, well, I get more use out of it in year 1 than year 2. So yeah, it does make sense for us to allocate more in year 1. It's a more productive piece of equipment in year 1 than in year 2. So there is a valid argument to do that. In terms of incentives on why people would want to use one or the other, notice for accounting, for general accounting, there may be pressure for people to look better. A lot of times, if they want it to look better in the first years, they might want to use the straight line because net income is higher, and we have the asset being higher for a longer period of time on the front. Of course, for accounting purposes, for generally accepted accounting purposes, we want to do what makes the best comparison. But there could be pressure to look good, of course, in terms of financial preparation. And on taxes, of course, we have the exact opposite. Remember, the tax code is different than generally accepted accounting or accrual principles. it'll tell you what kind of, you basically have a lot less flexibility. But for taxes, if we could choose, we would probably want to have an accelerated method, because we would rather lower net income look worse in year one, thereby lowering our taxes that we're going to pay on basically kind of net income in year one, and then we'll pay more in later years. Again, the net income will be the same over the time frame, but if we can get the money earlier, usually that's what we would want to do. Now, we might say that, well, if we don't really know which one is better, why don't we have a method that's more accurate? And the method that we usually think is more accurate would be something like units of production. Why would it be more accurate? Well, similar to driving a car, if we want to estimate the loss in value of that car, we can divide the car over the useful life, the number of years, but it might be more accurate for us to divide it by the expected miles it's going to drive or something like that. Why? Because the expected miles might be a more significant correlation between the deterioration of the car than just time, and that would be similar to a units of production. So units of production, if we took something like a printer, we could say, well, instead of just taking that printer and dividing it by the useful life in terms of time, let's divide it by how many pages the thing says it's going to print over its life on the box. And if we do that, then we can figure out how much has depreciated each year by counting the pages, and then multiply it by this rate that we have decided based on the number of pages over the useful life. And that would be considered usually to be more accurate. And that's what we're going to talk about next time. Note that in this problem, if we did that more accurate type of method, theoretically, then it does look like the depreciation in this problem is higher in beginning years than later years. Not quite as drastic as the double declining balance, but this problem is kind of justifying some reason for the double declining balance, being that the equipment could very well be more productive in year one than in year four in this case. So also want to point out that we could, for accounting purposes, use different methods rather than double declining. We could use 150 declining or any type of accelerated method in the front years to do that as well. So double declining is the most common. It's similar to methods that are often used on the tax code, a similar calculation to the tax codes, the methods mandated by the tax code. So we are now able to calculate depreciation using the double declining method, create a journal entry related to depreciation, explain the effect of recording the journal entry related to depreciation on assets, equity, and net income. Hello, in this lecture we will calculate depreciation using the units of production method. At the end of this, we will be able to calculate depreciation using the units of production method, create the journal entry related to depreciation, explain the effects of recording the journal entry related to depreciation on assets, equity, and net income. So in the past, we have calculated depreciation using the same information, using the most common sense type of method, that the first method that we would probably think of when allocating this process, that being the straight line method. So for example, if we had our piece of equipment for $257,500, let's first think about the problem that we have and then how we can solve that problem. So the problem is that if we just expense that $257,500 when we buy the equipment, then it will greatly reduce net income at the time of purchase, and that does not necessarily match in accordance with the accrual principle of matching the expense to the revenue it helped to generate. For example, it would make the net income for the year of purchase a lot lower because of that purchase, and then the next year the income would most likely be higher because this expense for this purchase is not included in the following year, although we are using the equipment in the following year. So the idea then is that we need to be able to compare the income statement from year to year. How can we do that? How can we allocate this expense in an appropriate way that we would believe is more appropriate, so that we can see a allocation of the expense and compare the income statement? The first thought to do that would be, well, maybe we should find the useful life to see how long we're going to use this piece of equipment, and then divide the cost by the useful life, allocate it across the time frame, and that therefore we would expense an equal amount throughout that time frame. that would be the straight line method. And an alternative method to that would be the double declining method. That would be a method thinking that the first year should have a greater amount of depreciation than the later years. So we would have a method that would basically front load the depreciation in the current years, in the beginning years, and then have less depreciation in the later years. The next method that we will talk out here is the units of production. The idea of the units of production method being that why are we using time at all as the measure? We should be using the units of production, meaning we should allocate not based on time, we should allocate based on a better driver in terms of how we will know how much cost has been used. So for example, in a car, instead of just depreciating over the time that we have had the car, why don't we depreciate using mileage in that case? So we'll depreciate not based on how old the car is, we'll depreciate based on how many miles has been driven. In a lot of ways, people would think that that would be a more accurate way of depreciating. So that's what we'll talk about here of systems such as that. So in this case, we got equipment purchased on January 1st costing $257,500, salvage value $20,000. Remember what salvage value means? That means that we can sell the equipment for the $20,000 at the end of its useful life. Now, we still have the information. It's going to be a 4-year useful life. That information is somewhat irrelevant here, but I want to keep it in there just to compare it to the prior methods that we have used. It'll still fit into the 4-year period in this case, so we can show that 4-year period comparison. But really what we're going to estimate is not based on the time. We're going to estimate on the units of production. So in this case, we believe that, this thing is going to produce 475,000 units. So you can imagine that if we got a printer or something like that, a very expensive printer in this case, that on the box it says, this printer will produce 475,000 pages. That would be the life of the printer in terms of production of what it will produce. So rather than taking the 4-year as the driving factor to allocate depreciation, we want to take the number of produced units in order to drive the allocation, in that example being pages to produce if it was some type of printer. So we will then allocate a cost per page or per unit in this case. That calculation would be the cost being the same cost as all of our other examples, $257,500. We're going to subtract from that the salvage value. Why? Because that's the floor. Remember that we're not going to depreciate this thing to zero even after we've used it. Like if it's a printer, even after it's no longer usable and all the rollers are gone and we can't use it, we still think that we can expense this thing for $20,000. Therefore, we have the floor of $20,000 rather than zero. That's the salvage value. That means that over the life not necessarily being 4 years in this case, it'll happen to work out to 4 years because we set it up that way, but the life being 475,000 pages will, at the end of that, we'll have accumulated depreciation of $237,500. What does that mean? It means that if we calculate the book value at the end of that, then we'll have a cost of $257,500 less the accumulated depreciation of $237,500, which will leave a value on the book value of $20,000 equivalent to the salvage value. So once we have the number that we're going to depreciate over the useful life, then we divide that not by the number of years as in prior examples, but by the number of units to be produced. If we're talking about pages on a printer, the number of pages. That means that each page theoretically is worth 0.50 cents basically per page. So now we're going to count the number of pages that are printed each year and multiply that times the rate we got, 50 cents per page. That's how we're going to get our depreciation. Note the extra work we need here. We need to know some extra facts that we did not need to know before. One, how many pages is it going to produce? That's got to be determined in some way, similarly to us having to determine the number of years. And two, we need to count the number of pages each year, which could be a daunting task depending on how automated the process is. So now when we calculate the depreciation for each year, the problem is going to have to give us one more piece of information, that piece of information being how many units did we produce. In this case, if we're talking about a printer, how many pages did we produce in that year? Once we have that, it becomes a fairly simple calculation to calculate the depreciation. Meaning, if they tell us we printed 220,000 units, we're going to take the number of units that were produced, multiply it times the rate that we just came up with. We said 50 cents per page. Therefore, if we multiply that out, then 220,000 times 50 cents gives us the depreciation of 110,000. So if we were then to do our calculation in terms of the book value, in terms of our table, we say the depreciation for year one is the 110,000 we just calculated. How do we calculate the book value? We take the cost, the 257.5, less the accumulated depreciation. What is accumulated depreciation? It's last year's accumulated depreciation plus the current year's depreciation expense, or the accumulation of all depreciation over the life up until this time period, which is just the current year. Therefore, it's the 110,000. And if we subtract that out, then we have a book value of 147.5. So if we take a look at the context of this in terms of other accounts, the journal entry, remember that we looked at the journal entry in the adjusting journal entry process. We just did not look at how to calculate it. So now we've done the calculation, but let's take a step back and remember that this is an adjusting journal entry that we are recording here. If we take a look at our list of accounts, we have assets in this case in green, and this side is before the transaction is being recorded. So we've got the assets, their debits represented by the fact that they do not have brackets. Then we have our equipment that is on the books at the cost that we paid for it. Nothing is in accumulated depreciation until we record this transaction. We've got the liabilities in brackets because they're credits. So credits are in brackets. The capital account, the equity section, revenue is a credit balance, so it's in brackets. And the only expense that we're going to look at this time will be the depreciation expense, because we want to isolate that expense and see the effect of that expense on the net income. So before we record the journal entry, net income is just the 100,000. We're assuming we earned 100,000 in year one before this adjusting process. In the adjusting process, we have one income statement account generally, pretty much all the time, one balance sheet account. The income statement account will of course be depreciation expense. Income statement expense accounts only have debit balances and they generally only go up. So therefore we're going to debit it, making it go up. And the other account that we're going to select is accumulated depreciation, which I've abbreviated here, and it will of course be a credit if we debit depreciation expense. Therefore the transaction looks like this: debit depreciation expense, credit accumulated depreciation. If we post that, then the depreciation expense is here, goes from 0 up by 110 in the debit direction to the 110. What happens to net income? It was at 100,000, just the 100 less the 0, minus the 110 means that we are actually at a loss now. The non-bracket numbers means the debits are winning, means the expenses are winning over the revenue. Therefore, we have a loss of 10,000 in this case. The depreciation expense is going to go from 0 up in the credit direction to 110. And note that that is a contra asset account, meaning it's green because it's in the assets section, but it has a negative or a credit balance. So that is contra to normal assets. You might ask, well, why does it have a credit balance? And the reason is that we do not want to write down the equipment directly because we're trying to tell our reader, hey, this is just an estimate. In contrast, if it was something like supplies, when we write down supplies, that's because we actually see a physical deterioration in supplies. I can go to supplies and count it and see that it has physically gone down. The number of units has gone down. On the other hand, if we take a look at the equipment, if it's a printer in this case, there's still only one giant printer that costs the $257.5, right? And it's not like the printer went away. We don't have less printers. We can't count the number of units. Therefore, we're trying to tell our reader, hey, we're breaking the T account between a T account to now a 7 and an R, right? We broke the T up, and the debit side is up here, the credit side is down here, and that's a rough estimate of this, and therefore that's what results in the contra asset account. If we take the 257.5 less the accumulated depreciation, that will of course be the book value of 147.5. Year 2. Very similar calculation, very easy until we get to the final year. The final year will change. So year 2, same thing. We're just going to say units produced in year 2. They're going to have to give us that number in the problem, and we'll just multiply that times our rate for the year that we calculated first off. Once we have that rate, very easy to calculate this. And then if we multiply that out, we got 62.3 in this case. That's the depreciation for year 2. If we look at that in terms of a table, here's where we were in year 1. If we look at the book value and the depreciation in year 2 and compare it, we can see that now the depreciation went down. That will not necessarily be the case. Year 2 could be higher than year 1. We don't really know what's going to happen from year to year because we're really basing it on the output of the machine, which we do think is more accurate. We could make the assumption that the first year will be better output than the second year, making the assumption that the machine is more productive in the first years than in later years. That would be a reasonable assumption. If this was what actually happened, these would back up that reasonable assumption. And then if we take a look at the book value, then we have the cost less accumulated depreciation. How do we calculate accumulated depreciation? Well, it could be the last year's accumulated depreciation plus the current year's depreciation expense will give us this 172.3, or we can add up the depreciation expense throughout the life of the equipment to this point being 110,000 plus the 62.3 would also give the 172.3. So the cost less the accumulated depreciation gives us the book value of 85,200. So if we look at this in terms of the transaction, then in terms of the accounts, this is where we start off in the adjusting process before this adjusting entry at the end of year 2 rather than year 1. We can see that we left off after year 1 and before recording this. In year 2 adjusting entry, we have the cost at 257.5 less the accumulated depreciation, book value for 147.5. We have nothing in depreciation expense. Why? Because that depreciation expense was carried into or closed out to the equity section, in this case the capital account. So note that the accumulated depreciation is a permanent account. It still has the 110 in it that we put in there in year 1. The depreciation expense does not still have the 110 in it because it is a temporary account which then closed out to the capital. We still do have the 100,000 in revenue, but it's not the same 100,000. The assumption is that year 2 we earned another 100,000, and the idea is that we want to have a model that we have the same amount of earnings in year 1 and year 2 so that we can then see the effect of depreciation on that net income if that was the case, holding all else equal. So the depreciation journal entry then would be the same. We're going to debit depreciation expense. We're going to credit accumulated depreciation for the amount calculated. That amount being the 62,300. So here's our journal entry. Here's the transaction, that what it will look like when we post this out. Depreciation expense is going to go from 0 up in the debit direction to 62,300. What happens to net income? It was at that 100,000 from the revenue, less the depreciation that we have recorded on the income statement, which is an expense, bringing the net income down to 37,700. What happens to accumulated depreciation? It goes up from 110 up in the credit direction. Same thing makes it go up. A credit and a credit makes the credit go up in the credit direction to 172.3. The book value then is the cost, 257.5 debit, less the 172.3 credit, giving us the book value of 85.2, which we see in the table. Year 3, very similar transaction. Once again, this is not the final year. It will change in the final year, but in year 3, we have the same thing. We're going to count the number of pages that were produced in that year, then multiply that times the rate that we determined being 50%, 50 cents per page. Remember that the problem will have to give you this number. It's going to have to tell you how many pages were produced. In real life, we would have to track that. The equipment that we got, in this case the printer, would have to somehow track the number of pages that have been printed, which is more than doable in today's technology. And so that would give us the 60,009 in year 3 depreciation expense in this case. So if we look at where we had before and now we add year 3, we can see that now we have 60,009. Again, it's a little bit less than the prior years, not as extreme a change from year 1. And once again, it should follow the actual use of the printer in this case, or whatever the machinery is. And the printing use could go up and down for reasons other than just the level of production that it is able to do. Our level of need may go up and down. And once again, just like driving a car, if we don't need to drive it, then you would think that it should depreciate less. We should be able to hold it onto it longer if we still take care of it, and it should be in better condition in that case. And so that's why this is generally thought of as a method that's probably closer to reality in terms of an estimate of value. So we can see that the cost is still the same. We're going to calculate the book value by the cost less The accumulated depreciation, what is the accumulated depreciation? It's last year's accumulated depreciation, the 172.3, plus the current year depreciation expense, the 60,009, will give us the 233,200 current year accumulated depreciation. We can also calculate it as adding up the depreciation expense throughout the 3 years, being the 110,000 plus the 62.3 plus the 60,009 should also give us the 233,2. We can see that the 257.5 of cost less the accumulated depreciation 233.2 will give us the book value at this point of 24,300. If we look at the journal entry then, remember where we're starting, we're in the adjusting process at this point before recording this adjusting entry of depreciation expense. So at the beginning of year 3, before this adjusting entry, we have the equipment on the books at 257.5, same thing, and we have the accumulated depreciation at 272.3. That's where we left off at the end of year 2. We can see that the depreciation expense is 0. Why is it 0? Because the amount that we put in there last year has now closed out to the capital account. It's closed out to the capital account is now 0. We can see that the revenue account is at 100,000. That's not the same 100,000. We're assuming we earned the exact same amount of money in year 3 as we did in prior years in order to hold all else equal so that we can see the effect of this journal entry over multiple years. So if we see the journal entry, then we're going to debit depreciation expense once again, credit accumulated depreciation once again for the amount calculated in year 3 being 60,900. If we look at the posting of that, then the depreciation is going to go from 0 up by 60,900. What does that do to net income? It brings the 100,000 down to 39,100. Once again, this is income, not a loss. The brackets represent a credit, not a negative number. So revenue is beating expenses by 39,100. What happens to accumulated depreciation? We have a contra asset account, an asset which has an unnormal credit balance of 172.3, goes up in the credit direction because we did the same thing to it, to 233,200. What's the book value now? If we look at this, 257.5 less the 233,200, the equipment, less the accumulated depreciation given, the 24,300. Now we're going to do this again. This happens to be the final year, and in this problem, of course, we knew that because it said it's a 4-year property. But once again, this information, we don't really even need to know that for units of production. But we do for this problem because we know it's going to be in comparison to the other problems because we want to compare the same time frame. But in reality, we may not even know how many years. We would estimate it most likely, but we're really going by how many units were produced. So what we're looking for in the final year is that if we calculate the book value after recording depreciation and the book value is less than the salvage value, remember that we need to stop there, similar to the double declining balance method. So we can see this most easily if there was no salvage value. So for example, obviously if there was no salvage value and we depreciated at 50 cents per page, and it happened to be that we printed more pages than we estimated to print, we printed more pages than the 475,000 pages, then if we keep on recording at 50% a page, we will end up with a book value below 0 at some point. And that's not feasible. We cannot have a printer that is worth negative money. That doesn't make any sense. The idea, of course, is to allocate the cost of 475 over the life of the printer. If we keep printing after we've completely allocated the cost, the estimate is wrong. In most cases, that's not a problem because the estimate will be wrong maybe by something that we believe is immaterial. So even though we're still using the printer, it's going to have a value of 0, meaning the cost less the accumulated depreciation, if there was no salvage value, would be at 0, and we just stop and we say, yep, we're still using it, but it's at 0 value. We think it's on its last leg. If it's a substantial difference that really affects the financial statements, we may have to make the adjustment or adjust the time frame at that point that we determine that. But for the most part, we're going to go with the estimate, and usually we're just going to stop depreciation at that point. If there's a salvage value, that remember means that that's the value that we believe we can scrap the equipment for even after it stopped being useful. then instead of the floor being 0, the floor is the salvage value. So in year 4, that happened to be the case. If we took the 15.2, for example, multiplied it times 50%, and then recorded the depreciation, we would come up to a book value less than 20,000. So I'm not going to do that practice, but just, take my word for it. It's the final year. It would not work. Therefore, we're going to do the thing that really kind of disturbs people sometimes when we want the math to work out perfectly and be really nice working. It doesn't work out perfectly, the math, unless we happen to produce exactly 475,000 pages and then the printer just died. That's the only time that the math would work out perfectly, and obviously that's not going to happen because this is just an estimate. So at the end of the final year, what we will have to do is say, okay, we're just going to do whatever we need to do to plug it so that the book value ends up at the 20,000 salvage value. Now, remember, once again, if you're doing a multiple choice question, probably not going to be asked to do this calculation in the final year because it would just be a lot of work for one multiple choice question on something like an exam. But you do want to be aware of that because it is relevant, and you do need to know that final year is going to be kind of a plug type year to make it work in both the double declining balance and the units of production method. So how can we do that? We can take the cost and subtract the salvage value, and that means that we need to depreciate the 237.5 over the useful life, so that at the end, when we're totally done calculating depreciation, meaning we want the accumulated depreciation to be 237.5. Why? Because then if we calculate the book value, the cost, less the accumulated depreciation of 237.5 will leave us with the salvage value of 20,000, which will be what we want because that's what we think the thing will be worth after we stop using it and we sell it for that amount or scrap it for that amount. So then we're going to subtract out the accumulated depreciation that we have accumulated to date. So up through year 3 in this case, we've already have an accumulated depreciation before recording depreciation for year 4 of 233.2. Therefore, we need another 4,200 in year 4 so that we stop exactly at the point at which the book value will be calculated to be 20,000. Let me show you what I mean on the table. Here's where we left off last time. Notice the book value last time was 24.3, and this time we need to depreciate that 4,003. Why? Because that will bring the accumulated depreciation up to 237.5. How do we calculate accumulated depreciation? It's prior year's accumulated depreciation of this 233.2 plus the current year's depreciation expense, 4,003, will give us this 237.5, or we can say it's the sum of all the depreciation expense up until this point in time, being year 1, 110,000, year 2, 62.3, plus year 3, 60,009, plus year 4 of 4,003 will also give us the 237.5. If we subtract out the cost, less the accumulated depreciation, the 257.5 less the 237.5, we get the 20,000, and that equals the salvage value being the floor. So now if we look at posting this final year, then we can take a look at our trial balance and notice once again we are in year 4 before we do the adjusting entry process, being recording the depreciation expense. We have the activity being the equipment on the books at 257.5 less the accumulated depreciation of 233.2, and that will give us a book value of the 24.3, which is where we left off at the end of year 3 in terms of the equipment and the accumulated depreciation account. In terms of the depreciation expense, we are at 0. Why? Because all prior year depreciation expense that we have recorded to this account have been closed out through the closing process to the equity account, in this case being the capital account. We also have the 100,000 here being revenue. This is not the same revenue as we have had in the last 3 years. It's assuming that we have been very consistent and we earned the same amount of revenue in year 4, and the idea being that we want to have everything constant, and so we're going to assume that we have earned the exact amount of revenue, have the expense only be depreciation expense, and see what the effect then is on the net income as we go. So in this case, we're going to do the same journal entry, and that will be a debit to depreciation expense a credit to accumulated depreciation. This is an adjusting journal entry. This is a journal entry we do at the end of the month or year, and the amount will be for the depreciation that we calculated, being the $4,300. If we record that, depreciation expense goes from 0 up in the debit direction to $4,300. The effect on net income is the $100,000 revenue that we earned in year 4, less this expense of $4,300 will give us the $957, the 100 minus the 43, the $957. On the accumulated depreciation, it goes from a credit balance up in the credit direction, because a credit and a credit is the same thing, making it go up, to the $237,500. We are now left with the $257,500 less the credit of $237,500, giving us $20,000 on the books. We're going to leave it there. That's where it's leaving, because that is equivalent to the salvage value, which is what we believe that we can expense the equipment for. So what happens in year 4? We don't post any depreciation expense. Does that mean that we just stop using the printer at that time and we don't print any more pages? Well, not if it's still working, but we're not going to record a cost less than what we think that we can sell the machine for. And clearly, of course, this would make a lot of more sense to drive the point home, is that if we recorded it to 0, then we could not record any more from that. We can't have a credit in this account larger than the cost that we bought the machine for. So the idea is that we are allocating the cost over the useful life. If we allocated incorrectly, then it's not the cost that was wrong, it's the allocation of the useful life that was wrong. So now let's take a look at a comparison between the 3 methods. Obviously, we're not doing these 3 methods at the same time. We're going to pick one of these methods in order to allocate the cost. And so we have the straight line, we've got the double declining, and we have the units of production. Remember, what happens under the straight line is that we have an even amount of depreciation over the 4 years. This would make a lot of sense to most people. This would be the first thing that most people would start to think of if they were confronted with this problem of trying to find comparability. And what happens to the book value? It goes down at a constant rate. If we look at that in terms of what happens to net income, notice that if we earned the exact same amount each year and held all else equal, being the only expense being depreciation expense, then we would have an even distribution. That would make a lot of sense. And note what the assumption is, though. The assumption is that the machine was used completely the same over the 4-year time period. And because we made the same amount of revenue, maybe that's the case because we had the same amount of production. But at the same time, it could be thought that the depreciation of the machine should be higher in the first year than the later years. One, because it's more productive in the first year, and there could be other factors, meaning that the value of the machine goes down just in terms of newer things coming out and stuff like that. And that would be an argument for the double declining method, which would be that we're going to front load the depreciation expense. Remember, over the 4-year time period, the depreciation will be the same, but now you can see that there's a lot more in year 1 than in year 4. We can see that in terms of the book value, what's the account on the book value, it goes down at a much higher rate in the beginning years than the later years. We end up in the same spot, meaning we're ending up at $20,000 at the end of the period. In this case, 4 years, we are in the same spot. So year 5 won't look any different under the 2 methods. So the question could be, a lot of people might ask, is why does it matter? Over the long run, it's okay. The short run, why does the short run matter? Well, there's a pretty substantial difference in the short run. So it could make a substantial difference in the short run when we're trying to think about the comparability, because really what we want to do is see, in terms of accounting, which one of these 2 allows us with the best to get the best comparability. Note that what happens to net income in this method is we actually end up with a loss in year 1, where we had income in year 1 under the straight line, and then we have income here versus income here. Now the income is higher in year 3, and the idea under the accounting method from a management standpoint is, which one of these 2 is most reflective? Did we really do worse in year 1 than in year 4, or is it fair for us to allocate more in year 1 than in year 4? Those are the questions. From a tax standpoint, note that if we had our preference, we'd probably want to depreciate more in year 1 than in year 4. Why? Because that will lower our tax bill, and we'd rather have the tax bill lower today than lower tomorrow, because I want to pay less taxes today because of the time value of money. So it really depends on what our incentives are in terms of which is most important. The major incentive I want to have in our heads when we think about accounting is which is more accurate for us to make better decisions. And then, of course, the unit of production method, the idea usually is that the unit of production method will be more accurate because we're using a method that's not just based on time, it's based on usage. So when you ask the question that should we depreciate more in year 1 than year 4, the answer that might test that method better would be, well, why don't we do it by testing what it produces rather than just time, and that will tell us whether the machine is making more output in year 1 than year 4. If we do that in this example, we note that it does. In year 1, we recorded depreciation based on its performance, and it performed more in year 1 than it did in later years. And of course, year 4 we had to plug in there because we're still using it, and it produced more than we estimated. But the assumption here would be that it was true, that it performed far better in year 1 than in later years, and that would kind of support the double declining balance method here. We can see the effect on net income. The effect on net income in this case happens to be kind of in between the straight line double declining. Doesn't necessarily have to be that way. That's just kind of the way it's worked out in this case. So we are now able to calculate depreciation using the units of production method, create the journal entry related to depreciation, and explain the effects of recording the journal entry related to depreciation on assets, equity, and net income. In this presentation, we will discuss change in estimates related to the calculation of depreciation. Remember that depreciation is the allocation of the cost of property, plant, and equipment over the useful life. Therefore, when we purchase the equipment, even if we paid cash for it, we're putting it on the books as an asset rather than expensing it at the time of purchase, and then we're going to allocate the cost over the life of that asset in accordance with the matching principle, trying to match up the expense with the related period in which it helps to generate revenue. So as we consume the property, plant, and equipment, we want to write off the expense when it has been consumed to help generate revenue. That gives us the best matching principle, the best comparability. Now to do that, of course, we have to use an estimate to do that. So it's not perfect when we make this estimate, and our estimating methods might be something like straight line or an accelerated method like double declining balance. No matter what method we use, however, it is just an estimate. And if it becomes clear in the future that our estimate is off, or we think that it's clear that we need to update the estimate, then what are we going to do? How are we going to do that? First, note that there's a couple areas where the estimate could clearly change. So when we have depreciation, the cost is the cost. We bought it for what we bought it for. That's not generally an estimate. What's an estimate is, one, the salvage value could be an estimate, meaning how much do we think it's going to be worth at the end of its useful life? How much do we think that we can scrap it for at the end of using it during its useful life? And two is going to be the useful life itself. How long do we think this thing is going to last? And how long are we going to be using this thing in operations? Those are the two things that could change. If there's a significant change in these, then we would want to go back and we want to take a look at it and say, okay, how are we going to deal with the fact that we have new information that now makes it so that one of these factors or both are now changed. When recording a change in estimate, we typically do it at the point in time that the change has taken place going forward. In other words, we typically won't go back in time and change the estimate back to the prior periods which have already passed. One reason for that is that it would change things within the past. It would be difficult for us to go through the books that had already been closed and then change the income statement, which would change retained earnings. So oftentimes we'll just draw a line and say, okay, we think that this estimate has changed at this point in time, and then make the calculation in order to change the estimate at this point in time moving forward. Let's take a look at this with an example. So here's going to be our data down here. We've got the cost of property, plant, and equipment at $50,000, salvage value $1,000, useful life starting at 3 years. Then at the end of year 2, we decide that the useful life actually has 3 at the beginning of year 3, the end of year 2. We think the useful life at that point has 4 more years to go. So that's a change in estimate, and we believe the salvage value is going to change from 1,000 to 500 as that change takes place. What we'll do is we'll use this original data here in order to record the depreciation, and then we'll consider what that change will do when it happens at the end of 2 years. So the original data, we're just going to say we had $50,000 cost. We had a salvage value of 1,000. This is just a straight line calculation. We're going to be doing straight line calculation. Then that gives us the 49,000 to be depreciated. 50,000 cost minus the salvage, what we think we'll be able to get for it for scrap at the end of its useful life, gives us the amount we're going to depreciate over its useful life, currently 3 years. So if we had 49,000 divided by 3 years that we're going to depreciate over, that gives us our 16,333. This is an estimated number here. It's really 16,333.333. We're estimated to the nearest dollar. So if we take a look at our book value calculation, always important to do this, by the way, because a book problem, even if we're doing this for a book problem, will generally always ask or could ask something other than just the depreciation. So being able to calculate depreciation is not the full, not everything you need to know. We need to know how to calculate the accumulated depreciation and how to calculate the book value, because those are going to be common forms of questions, and just to understand, of course, the concepts. So the book value at the end of year 1 is going to be the cost, 50,000, less the accumulated depreciation, which is only 1 year at this point, being just this 16,333. Subtracting out the 50,000 minus the 16,333, we have a book value after year 1 of 33,667. If we had a straight line method, which we calculated here, and we did that for year 2, we would still have a cost of 50,000, and the accumulated depreciation now would be that 16,333 from the prior year plus the current year's 16,333, or 32,667. Then the 50,000 minus the 32,667 would give us that 17,333. Now we would do this for another year, and if we did that under the normal method, we would get down to a salvage value of 1,000, the useful life having been completed, and we would have fully depreciated. However, we have a situation here where we're saying at the end of year 2, at this point in time, there is a change in estimate. We think it's going to last 4 more years. Now, if we were to just end it off in year 3, then we couldn't extend the useful life because there would be nothing left to depreciate. In other words, at this point in time, we're not going back to the original 50,000. We're not going to update years 1 and 2. What we're going to do is go from at the end of year 2, beginning of year 3, forward in order to make our adjustment. Part of the reason for that is that this depreciation has already been included in the expenses for years 1 and 2, and then has been closed out to retained earnings. So it's basically the expense half of this calculation is gone. It's already passed its timing. The time has gone. So in order to change it, we'd have to go back retroactively and recalculate the prior year's income statement, and then roll forward and reclose out the income statement to adjust retained earnings going forward. It oftentimes might not be most useful to do that. What we can do instead, so we can say, okay, we've figured out the adjustment at this point in time. We're going to say this is where we stand at this point in time. This isn't the cost, it's the book value as of the end of year 2, and then take that and adjust it going forward to allocate it out to the 4 years and the new salvage value. To do that, we're going to do basically just the same type of straight line calculation. However, instead of starting with the cost, we will start with the book value of where we're at, the 17,333 at the end of year 2. Then we'll subtract out the salvage, which has changed now to 500 from 1,000. If we subtract that out, the 17,333 minus 500 gives us 16,833. Useful life, we're going to say, is 4 years now. So it's 4 more years. It's already been 2 years. And now we decided at the end of year 2 it's going to last 4 more years. 4 years $16,833 to be depreciated divided by 4 more years gives us depreciation per year for the next 4 years, 4,208. So now if we calculate the depreciation or our book value, we get the 50,000 cost still, and then the accumulated depreciation. Now I won't go back to the prior slide to pick up the prior one, but we'll see it going forward. It would be the accumulated depreciation for the last time period plus the 4,208, which gives us the 36,875. Subtracting out the 50,000 plus the new accumulated depreciation brings it down to 13,125. So in essence, this is where we stood book value wise in the prior year. Now we're at 13,125. Going forward, we have the same 50,000. Then we're going to take this prior period's accumulated depreciation, 36,875, plus the current year's depreciation that we have calculated using a straight line method, 4,208, to give us 41,083. The 50,000 minus the 41,083 gives us 8,917. If we do this again, we've got the 50,000, then we're going to add in the accumulated depreciation, 41,083 and the 4,208 to give us 45,292. The 50,000 minus the 45,292 gives us 4,708. We'll do this one more time. We've got the 50,000, then we got the accumulated depreciation being the 45,292 from the prior time period, plus the current period's depreciation, 4,208, giving us 49,500. Subtracting out the 50,000 minus the 49,500 gives us the 5,000. So you can see as we start from this point in time, we can arrive at the 500, our stopping point, that being the salvage value, without having gone back and made the changes to the original estimate. We didn't make this calculation based on the 50,000 cost. We basically took the book value as of the point in time that we thought the estimate had changed, that being 17,333, then moving forward with that based on the new information that we have. In this presentation, we will discuss change in estimates related to the calculation of depreciation. Remember that depreciation is the allocation of the cost of property, plant, and equipment over the useful life. Therefore, when we purchase the equipment, even if we paid cash for it, we're putting it on the books as an asset rather than expensing it at the time of purchase, and then we're going to allocate the cost over the life of that asset in accordance with the matching principle, trying to match up the expense with the related period in which it helps to generate revenue. So as we consume the property, plant, and equipment, we want to write off the expense when it has been consumed to help generate revenue. That gives us the best matching principle, the best comparability. Now to do that, of course, we have to use an estimate to do that. So it's not perfect when we make this estimate, and our estimating methods might be something like straight line or an accelerated method like double declining balance. No matter what method we use, however, it is just an estimate. And if it becomes clear in the future that our estimate is off, or we think that it's clear that we need to update the estimate, then what are we going to do? How are we going to do that? First, note that there's a couple areas where the estimate could clearly change. So when we have depreciation, the cost is the cost. We bought it for what we bought it for. That's not generally an estimate. What's an estimate is, one, the salvage value could be an estimate, meaning how much do we think it's going to be worth at the end of its useful life? How much do we think that we can scrap it for at the end of using it during its useful life? And two is going to be the useful life itself. How long do we think this thing is going to last? And how long are we going to be using this thing in operations? Those are the two things that could change. If there's a significant change in these, then we would want to go back and we want to take a look at it and say, okay, how are we going to deal with the fact that we have new information that now makes it so that one of these factors or both are now changed. When recording a change in estimate, we typically do it at the point in time that the change has taken place going forward. In other words, we typically won't go back in time and change the estimate back to the prior periods which have already passed. One reason for that is that it would change things within the past. It would be difficult for us to go through the books that had already been closed and then change the income statement, which would change retained earnings. So oftentimes we'll just draw a line and say, okay, We think that this estimate has changed at this point in time, and then make the calculation in order to change the estimate at this point in time moving forward. Let's take a look at this with an example. So here's going to be our data down here. We've got the cost of property, plant, and equipment at $50,000, salvage value $1,000, useful life starting at 3 years. Then at the end of year 2, we decide that the useful life actually has 3 at the beginning of year 3, the end of year 2. We think the useful life at that point has 4 more years to go. So that's a change in estimate, and we believe the salvage value is going to change from 1,000 to 500 as that change takes place. What we'll do is we'll use this original data here in order to record the depreciation, and then we'll consider what that change will do when it happens at the end of 2 years. So the original data, we're just going to say we had $50,000 cost. We had a salvage value of 1,000. This is just a straight line calculation. We're going to be doing straight line calculation. Then that gives us the 49,000 to be depreciated. 50,000 cost minus the salvage, what we think we'll be able to get for it for scrap at the end of its useful life, gives us the amount we're going to depreciate over its useful life, currently 3 years. So if we had 49,000 divided by 3 years that we're going to depreciate over, that gives us our 16,333. This is an estimated number here. It's really 16,333.333. We're estimated to the nearest dollar. So if we take a look at our book value calculation, always important to do this, by the way, because a book problem, even if we're doing this for a book problem, will generally always ask or could ask something other than just the depreciation. So being able to calculate depreciation is not the full, not everything you need to know. We need to know how to calculate the accumulated depreciation and how to calculate the book value, because those are going to be common forms of questions, and just to understand, of course, the concepts. So the book value at the end of year 1 is going to be the cost, 50,000, less the accumulated depreciation, which is only 1 year at this point, being just this 16,333. Subtracting out the 50,000 minus the 16,333, we have a book value after year 1 of 33,667. If we had a straight line method, which we calculated here, and we did that for year 2, we would still have a cost of 50,000, and the accumulated depreciation now would be that 16,333 from the prior year plus the current year's 16,333, or 32,667. Then the 50,000 minus the 32,667 would give us that 17,333. Now we would do this for another year, and if we did that under the normal method, we would get down to a salvage value of 1,000, the useful life having been completed, and we would have fully depreciated. However, we have a situation here where we're saying at the end of year 2, at this point in time, there is a change in estimate. We think it's going to last 4 more years. Now, if we were to just end it off in year 3, then we couldn't extend the useful life because there would be nothing left to depreciate. In other words, at this point in time, we're not going back to the original 50,000. We're not going to update years 1 and 2. What we're going to do is go from at the end of year 2, beginning of year 3, forward in order to make our adjustment. Part of the reason for that is that this depreciation has already been included in the expenses for years 1 and 2, and then has been closed out to retained earnings. So it's basically the expense half of this calculation is gone. It's already passed its timing. The time has gone. So in order to change it, we'd have to go back retroactively and recalculate the prior year's income statement, and then roll forward and reclose out the income statement to adjust retained earnings going forward. It oftentimes might not be most useful to do that. What we can do instead, so we can say, okay, we've figured out the adjustment at this point in time. We're going to say this is where we stand at this point in time. This isn't the cost, it's the book value as of the end of year 2, and then take that and adjust it going forward to allocate it out to the 4 years and the new salvage value. To do that, we're going to do basically just the same type of straight line calculation. However, instead of starting with the cost, we will start with the book value of where we're at, the 17,333 at the end of year 2. Then we'll subtract out the salvage, which has changed now to 500 from 1,000. If we subtract that out, the 17,333 minus 500 gives us 16,833. Useful life, we're going to say, is 4 years now. So it's 4 more years. It's already been 2 years. And now we decided at the end of year 2 it's going to last 4 more years. 4 years, 16,833 to be depreciated divided by 4 more years gives us depreciation per year for the next 4 years, 4,208. So now if we calculate the depreciation or our book value, we get the 50,000 cost still, and then the accumulated depreciation. Now I won't go back to the prior slide to pick up the prior one, but we'll see it going forward. It would be the accumulated depreciation for the last time period plus the 4,208, which gives us the 36,875. Subtracting out the 50,000 plus the new accumulated depreciation brings it down to 13,125. So in essence, this is where we stood book value wise in the prior year. Now we're at 13,125. Going forward, we have the same 50,000. Then we're going to take this prior period's accumulated depreciation, 36,875, plus the current year's depreciation that we have calculated using a straight line method, 4,208, to give us 41,083. The 50,000 minus the 41,083 gives us 8,917. If we do this again, we've got the 50,000, then we're going to add in the accumulated depreciation, 41,083 and the 4,208 to give us 45,292. The 50,000 minus the 45,292 gives us 4,708. We'll do this one more time. We've got the 50,000, then we got the accumulated depreciation being the 45,292 from the prior time period, plus the current period's depreciation, 4,208, giving us 49,500. Subtracting out the 50,000 minus the 49,500 gives us the 5,000. So you can see as we start from this point in time, we can arrive at the 500, our stopping point, that being the salvage value, without having gone back and made the changes to the original estimate. We didn't make this calculation based on the 50,000 cost. We basically took the book value as of the point in time that we thought the estimate had changed, that being 17,333, then moving forward with that based on the new information that we have. In this presentation, we will take a look at the disposal process for property, plant, and equipment for fully depreciated fixed assets. Whenever considering the disposal process, we want to go through a series of questions to make sure we get the process down. It is a bit more complicated of a transaction and journal entry, but not too bad. When thinking about the list of questions, I would think about it in terms of constructing the journal entry. So when you construct the journal entry, the first thing we typically ask is cash affected? Did we get any cash for the disposal? We may or may not get cash. In our example here, we're going to start off with an example where we don't get cash, but we want to go through the same steps, whether we get cash or not, to think through the transaction in such a way that it will work for any type of disposal transaction we have. If we get cash, then of course we can work our debits and credits. We can say, well, cash would be debited by whatever we then receive. Now what we next need to do is take the equipment off the books and the accumulated depreciation. So in order to do that, we are going to credit the equipment. It's an asset, and the credit to equipment should be something that we can reason through pretty easily, even if we don't have a trial balance in front of us, which I do recommend having a trial balance in front of you, even if it's not the trial balance related to a problem that you're working on, because it'll help you to see the debits and credits and what they are. If we have the trial balance in front of us, it's really easy to see, this is a debit balance account. We need to take it off the books with a credit. And what's not so easy to see without a trial balance is the accumulated depreciation, it being a contra asset account, it being related to the fixed asset account that we're taking off the books, and therefore can't be left on the books if we're taking the equipment off the books. So we need to then debit the accumulated depreciation. It is a contra asset account. It has a credit balance. We need to take it off the books, so we're going to do the opposite thing to it, a debit. And then the last step we'll have here is, we'll see, do the debits and credits match? And if they do not match, then we'll have to do whatever we need to do in order to make them match, meaning we will have the kind of plug here, which will either be a gain or a loss. In other words, if the cash received is greater than the book value, the fixed assets minus the accumulated depreciation, that will result in the plug that is necessary to be a credit, and that will then increase net income. If, on the other hand, the cash we received is less than the book value, the fixed asset minus accumulated depreciation, then the thing we will need here, the plug, will be a debit, and that will reduce net income. Now that should seem a little intuitive as well, because the credits on the income statement, which this is an income statement account, will increase income, meaning revenue accounts are income accounts increasing net income, and debit accounts will decrease it. Expenses are typically debits. Therefore, if it's a gain, it's going to be a credit, like revenue account, increasing income. If it's a loss, it's going to be a debit, like expense type accounts, decreasing net income. So if we look at our example here, we're going to talk about an example that has a fully depreciated equipment. Now, in this example, we have the equipment here, and it's fully depreciated. We're assuming here that this is the only piece of equipment on the books, which is not going to typically be the case, but is great for an example problem so that we can see the trial balance. In real life, what would happen is, of course, we would have this equipment account, which would be supported by a subsidiary ledger account, which would just list out all the assets and the accumulated depreciation. So we're going to put say that we only have one asset here, one equipment worth 110, so we can see exactly what happens in the context of debits and credits, in the context of seeing everything else that would be involved, seeing that we're in balance, meaning the debits that are positive numbers minus the credits that are negative numbers add up to a zero balance. Net income is the 100,000 sales or revenue minus the 30 minus the 4,000 for the 66,000. So if we take this off the books, then what we need to do is take the equipment off the books. It has a debit balance. We're removing it from the books with a credit. All we're going to do is credit the entire amount for that equipment. And then the other side we have to take off the books is accumulated depreciation. It has a credit balance. We're going to take it off the books by doing the opposite thing to it, a debit. Now note that this is the easiest type of journal entry we have in a disposal process because it's fully depreciated. And the fact that it's fully depreciated means we don't need to do any added depreciation at this time because we can't. It's fully depreciated. There is no more depreciation to allocate. Also important to note that just because something has been fully depreciated, in other words, just because the accumulated depreciation is equal to the equipment and therefore has a book value of 0, does not necessarily mean that the company is not still using the equipment. It may still be used, and if it is, then we can't take it off the books. We want to tell our reader, hey, we still have this equipment. It's been fully depreciated. That means that we've allocated the cost over what we thought was going to be the life of the equipment. However, our estimate was off because we're still using the equipment, and so we still have it. So we want to keep it on the books in that case. If, on the other hand, it's fully depreciated and at this point in time we decide to remove the equipment, then we need to take it off the books to tell our reader, yeah, it's fully depreciated. It's not adding anything to net income, to the assets here. However, we want to remove it from the books and just show you that we don't even have it anymore. It's not something that we are using in operations at this time. So that's what this transaction is going to do. If we post this out, then the equipment account has a credit here. That credit will be posted to the equipment, so it has 110. Starting with a debit, we posted a credit to it from this journal entry, bringing the balance down to 0. Then the accumulated depreciation, we're going to debit it. So it started with a credit of 110,000. We're going to debit it, 110,000, bringing us down to 0. So if we look at all the accounts here, we can see that it did what we would expect it to do. It took the equipment fully off the books. And remember, this is just representing one piece of equipment that we're saying is being removed. And again, if it was a larger company, we would have multiple pieces of equipment, and we would still be left with a balance representing all the equipment that remains. The only difference being that we would get this number from a subsidiary ledger account, which would list out the equipment and the accumulated depreciation, which we are removing. So then note also that there's nothing happening to the income statement here. There's no debits or credits down here to revenue or expense accounts. It's already been fully depreciated. We can't depreciate it anymore at this point in time. And there's no gain or loss because the book value is equivalent to the equipment account. That means that we wrote it off, and that means that there was no salvage value in our estimate. And therefore, when we write it off, there's no loss when we write this off. In this presentation, we will take a look at the disposal of property, plant, and equipment for a fixed asset that is fully depreciated and cash is received upon the disposal process. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Whenever we think of any disposal, we do want to go through our series of questions related to the disposal process so that we have a system to go through in each case, each scenario that will work. I would do this with a journal entry, this series of questions, starting off with our question of, is cash affected? If it is, then we know we're going to start our journal entry with a debit to cash. The next component is to remove the property, plant, and equipment and the related accumulated depreciation from the trial balance. We can do that with a debit to accumulated depreciation and a credit to the fixed asset account. Then we can look at these and we can say, okay, is there going to be a debit or credit remaining? Meaning if cash is greater than the book value, cash is greater than the fixed asset minus the accumulated depreciation, we'll have a credit that we will need. That will be a gain. If on the other hand, the cash we received is less than the book value, less than the fixed asset minus the accumulated depreciation, the item we will need will be a loss. So that's going to be determining whether we have a gain or a loss. In our example here, we're talking about a fixed asset that is fully depreciated. We can see it on the trial balance, and I do recommend that you always have a trial balance in front of you, even if it's not the trial balance for the problem you're working on, just so you can see what the equipment is, what the accumulated depreciation is, and the depreciation accounts, and have some idea of whether they're debit or credit accounts and how to remove them. In our trial balance, the debits are represented with non-bracketed numbers or positive numbers. The credits with bracketed numbers, the debits minus the credits then being equal to 0, meaning we are in balance. The revenue minus the expenses is the $66,000 net income. In this scenario, we can see that it's fully depreciated, this piece of equipment that we're selling, this 110 representing one piece of equipment. Because it's fully depreciated here, the accumulated depreciation is equal to the equipment. That means that it's fully depreciated and there's no salvage value. In other words, the book value at this point in time is equipment minus accumulated depreciation, or 0. So we don't need to do any more depreciation expense. We don't need to say, hey, is there any depreciation we need to record before we make our adjustments here, because it's fully depreciated. There's no other depreciation we can record at this point in time. So our goal here first is cash affected. We're going to say that we scrapped it for $500. We got cash. So cash is a debit balance account. We're going to increase that by the 500. Then we're just going to go through this and remove the equipment and accumulated depreciation. Something that's very easy if we have the trial balance and or the subledger listing that information out for us. And so if we're then just going to remove the equipment, it's got a debit balance here. We're going to do the opposite thing to it to take it off the books, a credit. And then the accumulated depreciation has a credit. We need to do the opposite thing to it, a debit, to take it off the books. Now, it could be confusing if we don't have the trial balance in front of us to know whether or not accumulated depreciation is a debit or credit, it being a contra asset account. That could be a bit confusing. However, it's important to note that whenever we remove the equipment, we need to remove the related accumulated depreciation amount as well. Then we're just going to see the debits and credits and see what we need in order to be in balance. So this of course adds up to 110,500 debits. Credits add up to 110,000 even. Therefore we need a credit of 500. Note here, this is going to be the full journal entry. Note that I didn't construct this in such a way that the debits are on top and the credits are on the bottom. If you're in a circumstance where you think it's very important to do that, then you can put the debits on top and the credits on bottom. I do recommend constructing it in whatever way makes sense. I think this is the easiest way to construct it to make sense. And if you don't have any restraints on putting the debits on tops just for formality purposes, it might be best even to leave it this way, because then when you go back to it, it's easier for you to go through your thought process. Say, okay, cash was first, equipment went off the books, and then accumulated depreciation. It's probably easier to read it from top to bottom than to read it from debits to credits. So for that reason, you might want to leave it in this format to go back and be able to review it. So that's going to be the transaction. Also note, it can be confusing to know whether or not this 500 is going to be a gain or a loss. A couple ways we can see that. One is that we can see, well, the book value is 0, meaning it's equipment minus accumulated depreciation. Therefore, the 500 we received minus a book value of 0 means that the whole 500 is gain to us. It's all a gain, and therefore it's a credit or a gain. The other way we can see it is we can say, well, it's a credit, and we know that the gain or loss account is going to be on the income statement. And on the income statement, credits are like good. Credits are like income. Income is credit accounts, revenue. And the expenses are typically bad. Those are like the expense accounts. So if we have a credit here, we have a gain, like revenue, which should increase net income, which would make sense in this case. So if we post this out, then we're going to post the cash here. So here's the cash posting out 500 plus the 500,000 gives us the 500,500. Then we're going to post out the equipment. So here's the equipment here. It started at 110,000 debit. We are crediting it by 110,000, bringing the balance down to 0. Then the accumulated depreciation here on the journal entry, we're going to post it here on the trial balance, starting out with a credit of 110,000, debiting by 110,000, bringing the balance to 0. And then we've got the 500 gain, and that's going to go to our gain or loss account that we have to add here. We're going to say the 0 in the credit direction by 500 to the 500. So if we look at the trial balance with all accounts included, we've got the cash going up from 500,000 by 500 to the 550. We see the equipment and accumulated depreciation being taken off the books, and we have this gain here, meaning the 66,000 of net income, which was the 100 minus the 30 minus the 4 gives us 66,000, is increased by the 500 to 66,500. This being net income, not a loss. That a result of the 500 cash received being greater than the book value, the equipment minus the accumulated depreciation, the result being a gain on disposal. For more accounting information and accounting courses, visit our website at accountinginstruction.info. In this presentation, we will take a look at the disposal of property, plant, and equipment for a piece of equipment that is not fully depreciated at the point of disposal. We'll take a look at the questions that we should go through, and I would think through a journal entry as we think through the closing process to work through what that process will be. Note here that we're going to go through the disposal process, and we also need to think about, has the depreciation been fully depreciated at the point in time it's being disposed of? In other words, is there some depreciation, some time that has passed since the prior period of the adjusting entry process, the period where we would record the adjusting entry of depreciation expense, and the point in time of disposal that we should record for depreciation? We'll take a look at that process as we work through. However, once the disposal is going to take place, we want to think first, is cash affected? I would then think of a journal entry. If cash is affected, we would debit cash for the cash we received. Then we take the equipment off the books as well as the accumulated depreciation. The difference then being a gain or loss on the disposal. If, in other words, we got more cash than the book value of the equipment, we would end up with a credit or a gain. If we got less cash than the book value of the equipment, we would end up with a debit or a loss. In our example, we're going to say that there's 5-year useful life property with no salvage value, and it's disposed of in the middle of the 5th year. So first we're going to go through that question about whether or not we need to record more depreciation before we go through the disposal journal entry. And that's going to happen if there's in the middle of the month or in the middle of the year, and we have this time frame, either a partial year or a partial month, in which there has been not recorded the depreciation journal entry because they're recorded as adjusting entries at the end of the time period. So in our case, we're saying that these adjusting entries are going to be recorded each year at the end of each year. And in the middle of year 5, the last year, we are disposing of this equipment before it's totally depreciated. And therefore, we need to account for, before we dispose of it, 1/2 year of depreciation, because the last year of depreciation happened at the end of year 4 when we did the adjusting process. We're in the middle of year 5, we're getting rid of the equipment, and we need to get it up to date in terms of those 6 months of depreciation that has not yet been recorded. To do that, we're going to take the cost of the equipment, which will be $110,000. We're going to divide that by the useful life using a straight line method. We don't have any salvage values, so we're not subtracting out the salvage. It's going to be a very simplified problem here, and that's going to give us the $22,000 depreciation per year. Now, we of course need half a year's depreciation to record for this problem that has not yet been recorded. Therefore, we'll divide that by 2 for half a year, and that'll give us $11,000 of depreciation we need to record. So if we look at our trial balance, then we see that we have the equipment at $110,000, accumulated depreciations at $88,000. And just to double check our calculations there, if we took the $88,000 divided by 11, or let's say 22,000, that's the depreciation per year, we get 4 years. So we can see that that 88 is for 4 years, and we're selling it in the middle, or not selling it, we're disposing in the middle of year 5. So that means we have to record that 11,000 half a years of depreciation to get it up to date before recording the disposal. So that's what we'll do first of all. And if we have the trial balance open, we can see that right away. We can say, oh, the equipment's on the books and it's not fully depreciated. And once that happens, we got to say, well, is the accumulated depreciation up to where it should be? When was the last time we did the adjusting entry? And if it's not, we'll make it what it should be with an adjustment, and then we'll do our normal disposal process. So the first entry will be just like any adjusting entry for depreciation. It's going to be depreciation expense, debit, for that $11,000, then credit accumulated depreciation for the $11,000. That'll be our first transaction. Once we do that, if we were to record this, the $88,000 would go to $99,000 in accumulated depreciation. Then we can do our normal type of journal entry, which is going to be 1, we take off the accumulated depreciation. So note it's going to be at $99,000 after this transaction because we have $88,000 plus the $11,000. It's now at $99,000. When we work these type of problems, and especially if we don't have the trial balance here and we just have these floating numbers that they give us in a word problem, that can even make it a little bit more difficult. It's nice to have a trial balance, even if it's not the trial balance you're working on with the same numbers, just to see that the accumulated depreciation is a credit balance account. It would go up with this credit because it would be doing the same thing to it, to 99, and you can then figure out the disposal process. We now need to take it off the books, debiting it by the 99. Then we're going to take the equipment off the books. It's on the books as an asset, $110,000, and we're going to do the opposite thing to it, a credit, $110. Then we're going to have the difference. Obviously, we have a credit $110, a debit of $99. The difference is $11,000, which is really, it's the half a year of depreciation we haven't recorded. So this $11,000 is the depreciation we recorded. We still have half a year of depreciation we did not record, and it's going to be a loss because we didn't get any cash for it. So in other words, on the books, we have the book value of $110,000 minus the accumulated depreciation is $99, and if we the difference being $11,000 book value, we didn't get any cash and therefore have a loss. So that's one way we know that this is not a gain but a loss. This is a loss transaction. And the other way we know is because it's a debit. If it was a debit, that's going to be kind of like an expense because it's a income statement account, and expenses will bring net income down. If we post this out, then we're going to say that the depreciation expense is here, It's going to bring depreciation from 0 up by 11,000 to 11,000. Accumulated depreciation, we're going to net these two out. So accumulated depreciation is going to be the 99 minus the 11. So I know we kind of netted those out. These two are being recorded at the same time. And so it's the 88. And then we're going to take out the 88, the 99 minus the 11, bringing the balance down to 0. And then we have the equipment at here. We're recording this 110,000 credit. Here's a debit. We're recording the credit to it, bringing it to 0. And then the loss on disposal being an income statement account going from 0 in the debit direction by 11,000 to 11,000. Looking at all the accounts, we can see that we have done what we want. We want to bring the equipment off the books. We've recorded that depreciation and recorded the gain. The effect on net income then is it was at 66,000, which is the credit minus the debits. So that's net income, not a loss. And then we had it go down, 1 by the depreciation we calculated, so the depreciation expense brought it down, and 2 by the loss that happened. So it went down by 22,000 of net income after the disposal process because we disposed of something that wasn't fully depreciated, and we had to record 1, the depreciation that hadn't been recorded up to this point, and then the loss resulting from the fact that it still had a book value and we didn't get any money for it, bringing the net income from 66,000 down by 22,000 to 55,000. In this presentation, we will record the disposal of property, plant, and equipment for equipment that is not fully depreciated and for which we are going to receive some cash at the point of disposal. When we think about the process of the disposal process, we want to think about the steps to go through that will fit just about any type of disposal process. We also want to think, too, about the journal entry that may be necessary in order to record depreciation up to the point of disposal. We'll talk about that more in a second. In order to record the disposal, I would think about it as a journal entry, first asking the question as to whether or not cash is received. If it is, we would debit cash. Then we would take the equipment off the books with a credit to the fixed asset and a debit to accumulated depreciation, both needing to be removed from the books. And then we're going to have a debit or credit remaining, a gain or loss, based on this information. In other words, if we got more cash than the book value of the property, plant, and equipment, than the asset minus the accumulated depreciation, we would have a gain. And if we got less cash than the book value of the property, plant, and equipment, the asset minus the accumulated depreciation, we would then have a loss. So if we look at our example this time, we're going to say that we have a 5-year useful life, no salvage value, disposed of in the middle of year 5. We're going to include to that we received 15,000 as well. But in this case, what we first want to do is calculate the amount of depreciation that has not yet been recorded. So we're saying it's 5-year property and we sold it in the middle of year 5. And our assumption here is that the depreciation is only being recorded at the end of each year. And whenever we have a situation where the depreciation, and it'll always be the situation where the adjusting process will only be at the end of the month or the end of the year, and if we sell something in the middle of the month or dispose of something in the middle of the month or year, then we're going to have to say, okay, what are we going to do about that time period or that recorded depreciation that took place that we haven't yet recorded, I should say, up to this time? Because in this case, we recorded depreciation as of the end of last year. 6 months have passed. We're not planning to record an adjusting entry for depreciation until the end of the year. So we have to account for that 6-month time period before we do the disposal process. Calculation for that, we're going to say the cost is 110. This will be a straight line depreciation calculation. We're going to divide by the useful life, 5 years. That'll give us depreciation per year, 22,000. And we need a half a year remaining that we didn't record yet. So we'll divide by 2 to get that half a year, and that'll give us 11,000. That'll be the depreciation for that half year. So then if we go to our trial balance, we can see that we have the debits and credits, the debits not bracketed or positive numbers, the credits bracketed or negative numbers, the 0 representing that the debits minus the credits equal 0 or the debits equal the credits. And net income is the revenue, 100,000 minus the expenses, this being revenue, not expense. We're going to go through this process of recording the journal entry, first recording the accumulated depreciation and depreciation, the adjusting entry, to get the book value up to where it should be at the point of disposal. And whenever we dispose of something, if we see that the equipment account is not the same as accumulated depreciation, then it's not fully depreciated, or there's some salvage value. In any case, we want to ask the question as to whether it's fully depreciated and whether or not we need an adjusting entry. In this case, we do. We just calculated it. The adjusting entry will be the same as the adjusting entry for property, plant, and equipment, which is a debit to the depreciation expense for that $11,000 and a credit to accumulated depreciation. Once we have that on the books, then this $88,000 would be gone up by that 11 to $99,000. Then we can take this off the books as we normally would. Once this has been recorded, we can then say, okay, now the equipment needs to go off the books, and we need to record the gain or loss, and we got this $15,000 of revenue on disposal. So is cash affected? We're going to say, yeah, we got cash, $15,000. Then we need to take the equipment and the accumulated depreciation off the books. So the accumulated depreciation, remember, it has a credit balance, and it's really 99 at this time, the 88,000 plus the 11,000, or 99. It has a credit balance. We're going to take it off the books, doing the opposite thing to it, a debit. The equipment is on the books for 110,000, debit. We're going to take it off the books by doing the opposite thing to it, a credit. And then the difference is going to be 4,000. Now the difference is, of course, this 15,000 plus the 99 minus the 110. The debits are winning, therefore we needed this credit to be in balance. So that's one way we know it's going to be a credit. Now when we see a credit, we need to know, oh, well, is that a gain or a loss? And one way we know it's going to be a gain in this case is because it is a credit, and it's an income statement account. And on income statement accounts, credits are typically good. They're like income. This is being a gain, which is basically kind of income, increasing net income. And a debit would be kind of like an expense, decreasing net income. The other way we know is that the 110,000 minus the 99,000 is the book value of this property, plant, and equipment. So how would we calculate the book value at this time? 110,000 minus 99,000. So we've got a $1,000 book. Let's do that again. That doesn't look right. 110,000 minus the 99,000 gives us 11,000 on the book value, and we sold it for 15,000. So if we subtract out the 15, we got 4,000 more dollars than the book value of the equipment. So that's going to be a gain in that case. If we record this out, then we're going to say that the depreciation here, this journal entry, bringing the 0 up by 11,000 to 11,000. The accumulated depreciation here is going to bring the 88,000 up by 11, but then we're going to combine that with this 99 so that we can put it on the same slide here. So we got the credit here and the debit here, which will ultimately bring this up by 11 to 99 and then back down by 99. So we're going to credit it by 11, debit it by 99, which is a net of 88, bringing it down to 0. And then the cash is going to be here. There's the 500,000, and we're going to debit it by 15, bring it up to 515. Credit to equipment. So here's the equipment count, 110,000. We will credit it by 110, bringing the balance to 0. And then we have the gain or loss. So here's the gain or loss, 0. It's going to go up by the 4,000 to 4,000. If we look at this in context in relation to all other accounts, we can see that the cash account went up by 15. We got the equipment and accumulated depreciation off the books, that being the goal. The depreciation expense went up by 11,000, bringing net income down. And then the gain went up by 4,000, bringing net income up. So in other words, net income was at 66,000. It went down by the depreciation that we had to record for that half a year that we had not yet recorded. And then it went up for the fact that we had a gain on the sale, meaning the cash we received was greater than the book value. The net then being a decrease in net income of the 7,000. So the net income started at 66, which was the 100,000 minus the 30,000 minus the 4,000. It then went down by 7,000 to 59,000. Or in other words, we had net income of 66,000. It went down by the depreciation of 11,000, then up by the gain on the disposal of 4,000 to 59,000. In this presentation, we will discuss capital expenditures and revenue expenditures and the difference between the two, using a forklift as an example when we go through the demonstrations. So we have the capital expenditures and the revenue expenditures, and often the question is, should something be capitalized as a capital expenditure or should it be expensed as a revenue expenditure? In other words, what statement should the expenditure go under? If it is a capital expenditure, it's going to go on the balance sheet. If it's a revenue expenditure, it's going to go on the income statement. If we think about something like our forklift here, the question is, if we do some maintenance to the forklift, is it a capital expenditure? Is it something we should put on the balance sheet and then expense over time? Or is it something that we should expense in year one? Should we put it on the balance sheet as we do with the forklift itself and expense the cost over some useful life? Or should we put it on the income statement and just expense it as it happens? Now, of course, the difference between those would be if we capitalize the expenditure, something like putting a whole new engine in the forklift, for example, it would then go on the balance sheet. Whereas if we did some maintenance on the forklift, then we would put it on the income statement. And there's always going to be some question in terms of how much repairs and maintenance should be put on the balance sheet and how much should be just expensed at the time of purchase. So expense recognition then would be deferred if we're talking about a capital expenditure, meaning we're not going to write off the expense at the point in time we have the expenditure. If we put a whole new engine into the forklift, then we're going to put it on the books as an asset as we did with the forklift itself, and then expense it over its useful life, depreciate it over its useful life. And that means we're going to defer the expense and we're not going to lower net income in year one. It will be lowering net income in later years. Whereas if it's just a normal repair, then we can just write it off in this year. We can put it on the books as an expense on the income statement, recognize it, and decrease net income. Note the different objectives we might have depending on whether we're looking at it in terms of wanting to look good for our financial statements or in terms of taxes. So in terms of wanting to look good, we would probably want to put it on the books as a capital expenditure. And note that wanting to look good or not look good is not the reason for us putting it on one or the other. We're trying to make our financial statements as fair as possible. But sometimes it helps to look at some type of objectives that may be there in terms of how would we look better? How would we look worse? When would someone want to look better or worse? If we're talking about looking better to present our financial statements possibly for a loan or investment, we'd probably want it as a capital asset because then we'd have more assets and we wouldn't be decreasing net income at the point in time of purchase. If we wanted to look worse, probably for taxes, then we would want to recognize it as a revenue expenditure and expense it now, have basically a deduction, lowering net income, lowering therefore the taxes. When considering net income then, under the capital expenditure, it's going to be higher in at least the year of the expense. So at the year of the expenditure that we have, the payment that we make, the net income would be higher because we wouldn't be expensing it at the point in time we make the payment. We would be putting it on the books as an asset, as we did, for example, with the forklift itself. Whereas if we were talking about a revenue expenditure, net income would then be lower. And again, you can kind of see how that would relate to taxes. If we were talking about taxes, we would rather have a lower net income. If we're talking about just looking good, we would rather have a higher net income. So we'd rather look good. If we're trying to get investments or financing the company, we would rather look worse if we're trying to lower our taxes that we end up paying. From a tax standpoint, the capital expenditure would result in higher taxes because we have the higher net income. Now, of course, this results in year one having higher taxes because we're not having anything on the income statement except for depreciation. If it was depreciated during that time period, we're not expensing the entire cost of it. Note that it is a timing difference, however, and then in later years, we're going to have the capital expenditure have lower revenue because we're going to be depreciating that expenditure. But so it's going to work itself out over the time period, over the life of the asset. However, for tax purposes, we would typically want to lower taxes early just because of the time value of money. So in the year of the expenditure, the year we make the payment, we're going to have higher taxes. And if we had a preference, we would rather have lower taxes now and typically higher taxes later if that's what had to happen, rather than having higher taxes now and lower taxes later. That's just the time value of money, unless there's some other factor involved, including tax rates going up or something like that in the future. And then we have, of course, the revenue expenditure, resulting in lower taxes at the point in the time frame of the expenditure being made. So, and that is because we are expensing it at the point it's made. So this can run into a lot of like tricky areas in terms of, well, what should we do in this particular case? Is it something that's going to be a capital expenditure, or is it something we can just write off an expense during this current time period? So to look at that, we consider generally ordinary repairs, which would be the revenue expenditures, and the betterments and extraordinary repairs, and those would be the things like the capital expenditures. So things that you think of as normal repairs would typically just be expensed. So if you think of the forklift, you're thinking about things like maintenance on the forklifts. If it doesn't increase the productivity of the forklift, does not extend the useful life, like an oil change or just normal maintenance on the forklift, those types of things that we're doing to the forklift is just to maintain it. It's not to change what it's doing. It's not trying to say that it's now a forklift that can do more stuff than it did before. It's not a forklift that's extending the useful life. It's still normal maintenance to achieve the normal useful life that we had already calculated it to be. As long as that's the case, then we will typically just expense it, and that'll be it. On the other hand, if it's a betterment and extraordinary repairs, then we're going to capitalize it. So that's going to be things like large overhauls. So if we put a whole new engine into the forklift, then you would think that would extend the useful life and therefore be something that we should capitalize and not just be a normal expense of the forklift. If it does extend the useful life beyond the original estimate, then that would typically be a sign that we need to capitalize it, because the original estimate when we bought the forklift said it had a useful life of so many time periods, so many years. Based on normal maintenance, if we do maintenance that is extraordinary, that's going to extend that useful life, then it is something that we should typically capitalize. So if we have this forklift, then we're talking about revenue expenditures would typically be something like the oil change, maintenance, normal type of things, just to get the forklift to its normal maintenance process, not things that are typically used in order to extend the life or have extraordinary betterments, or to make the forklift be able to achieve something it was not originally purchased to do. And then if it's a capital expenditure, then maybe it's a complete overhaul. Maybe we change the whole engine in it. Maybe we overhaul the forklift to have some job other than just being a forklift. We make it into some other type of vehicle that can help us out with other type of operations. If that's the case, if it extends the useful life or changes the functionality of the forklift in some way, some substantial way, then we would basically want to capitalize the expenditure as we did with the forklift itself, and then depreciate it over the useful life. In this presentation, we will take a look at the depreciation calculation for a partial year. When considering depreciation calculations, we typically think of whole months or whole years in order to simplify that process and learn the different types of methods, including straight line, double declining, units of production. However, it's often the case where the depreciation needs to take place or something has been purchased in the middle of the time period, the middle of the month, or the middle of the year. To account for that, we could take a fraction of the time period, and that's what we'll do here. We'll be using a straight line depreciation method, but a similar principle will apply to all types of depreciation methods. We've got the cost here, the salvage value being 1,000. We purchased it on 10/1, October 1st, and the useful life is 3 years. So if we go through our normal kind of straight line calculation here, we're going to say that the cost is 10,000, and note where we're starting from. We're just going to start and get that depreciation per year. We're not going to try to figure out from point 1 what this fraction of the first year is. First, we're going to figure out depreciation for an entire year, And then we'll try to figure out, okay, what are we going to do about this fact that we bought it in the middle of the year and deal with that issue. Of course, how we're going to deal with that is that we're going to have part of the depreciation in year one and then part of the depreciation in the final year. And therefore, the 3-year property is going to really be running through 4 years, which is half of year 1, half of year 4, a full year 2 and 3. So let's see how that'll work. We're going to do the normal calculation, which will be the cost. So we'll take the cost, 10,000. We will subtract out the salvage value in our normal type calculation. That will give us the amount that needs to be depreciated, 9,000 in this case. So 10,000 minus 1,000 gives us the 9,000. That's how much we need to depreciate over the useful life of 3 years. So we're going to take that 9,000 and just divide it by 3. That will give us the depreciation per year. So here's our depreciation per year. Now our problem is that we didn't buy it at the beginning of the year. In this case, we bought it in October. Now, when you figure out the number of months that it was used, note that we have to figure out, okay, it's October 1st. That's by the beginning of the month, so you have to include October when you do the counting. So when you count, if you count it on your fingers, October, November, December, we got the 3 months there, October, November, December. Just make sure to include October. If it was October, the end of October, then you may not include, you may just have November and December and have 2 months. So how are we going to account for that? We could say, okay, there's 3,000 per year. Why don't we see how much per month we need now? So we're going to break this down into a monthly amount by dividing by 12 months. And that will give us a monthly depreciation of 250. So we got a 250 monthly depreciation, and we bought it in October. October, November, December means we had it for 3 months. So we can then take the 3 months and multiply it times the 250 per month depreciation to give us 750. Now note, if you see that in a book, they might simplify this calculation, or actually I think this is the easiest way to think about it. But they may represent it with a fraction, because they could say, well, we had it for 3 months divided by or over compared to 12 months, which would be 0.25 times the 3,000. And if you were to write something out, if you were to just write it out in a book, that would be the shortest way to do it, 3 over 12 times 3,000. And you could even write it even quicker by saying 3 over 12 can be simplified down to 1 over 4. So if you see a problem that says 1 over 4 times 3,000, that's the most simplified term in order to record this portion of the year. However, it's probably more confusing than if you write out the long way here. Say, okay, I have 3,000 a year. I'm going to break it out into units of months divided by 12 to get the units of months, 250. And then there's 3 months in the current year that we had used this 3, and then you get to the 750. So I think that's the easiest way to think through your own calculations. If you look at other people's calculations, especially book calculations, they will also often simplify the process down to write it as shortly as possible, not to be able to go back and read it as easily as possible. Okay, so if we have that, then we're going to say that the book value will be calculated in year 1 as the cost of 10,000 minus the accumulated depreciation, which is just the depreciation for year 1. That's all we have now. Gives us the book value in year 1 of 9,250. Remember that you really need, they can ask you for the depreciation here, and it's great to get to that point. But it's really common, even for multiple choice questions, to ask for the book value or the accumulated depreciation, just to give a little extra level of complexity. So make sure to be able to calculate both depreciation and at least a couple years of the accumulated depreciation and book value. So in year 2, we would take the 10,000, and then we have a full year of depreciation, 3,000, plus the 750 from the prior period, meaning the accumulated depreciation is 750 from last year, plus this year's full year of depreciation, not the 750 partial year. And that gives us 3,750. 10,000 minus 3,750 gives us 6,250. Then we're going to do this for year 3. We've got 10,000, same cost. Accumulated depreciation is now the 3,000 750, prior year's accumulated depreciation, plus another 3,000. You can also think of it as just the depreciation that has been calculated over the 3-year period, which is the 750 plus 3,000 plus 3,000. That's the same thing as saying the prior year's accumulated depreciation plus the current year's depreciation expense gives us 6,750. 10,000 minus 6,750 leaves us at 3,250. Now in year 4, of course, we have this partial year again. So we're going to have the same 10,000, but now we got this partial year. If there was 750 recorded in year 1, the other half of, or the other portion of the 3,000 is going to have to be recorded in year 4. Let's go through the same calculation one more time to get to that. We're going to say that the straight line calculation is the 10,000 cost. This is the exact same calculation until we get to the green part here. Divided or minus the salvage value gives us the amount to be depreciated, 9,000. And then we're going to take that and divide it by the number of years, 3. And remember, that's how we got to our 3,000. So here's our 3,000 per year. Now we need to figure out the partial year for the last year. So in other words, if we had it for 10, 11, 12 in year 1, 3 months, then 12 minus 3, what happened there? 12 minus 3, we had it for 9 months in the final year, in year 4. So we'll do the same calculation. It's 3,000 and divided by 12 gives us 250 per month. And now we're going to multiply that not times 3, which happened in year 1, but by 9, which happened in year 4, and that'll give us the 2,250. The other way you can do this, of course, is to just say, well, if this is a full year of depreciation, 3,000, and we already depreciated 750 in year 1, then we need to get the other part of that 3,000 to get to the full year between year 1 and year 4, so we can subtract minus the 750, gives us that 2,250. So then we can complete this. We're going to say that we have the 10,000 here minus the 9,000, which is the accumulated depreciation of 6,750 from last year, plus the current year's 2,250. That'll give us the 9,000. You can also think of it as just adding up all the depreciation over the life, which started out with the 750, and then we added 3,000 plus 3,000 plus now 2,250. So what have we done? Accumulated over the life. We had 750 in year 1, plus 3,000 in year 2, plus 3,000 in year 3, plus now 2,250 in year 4. Or we already did that all the way through year 3. So we had accumulated depreciation of 6,750 in year 3, plus year 4 depreciation expense 2,250. That'll give us our 9,000. Then if we subtract that out, the 10,000 minus the 9,000, we get to the 1,000, which should be and is our salvage value. And it's great to be able to go through the whole problem so that you can have that, you can get to that check figure where you should remain at and get to the salvage value.